welcome. So today we'll be having 3 courses, and we'd like you to know that the 3 courses run concurrently. We'll be starting with alternative investment that will be taken by Mohammed Buba CFA. This will be from 9 to 10 a.m. And second class will be economics that will be taken by Damilare Ojo CFA from 10 a.m. to 12 noon. And the third class for the day will be taken by Abiola Ahmed CFA, which is corporate issuers, and that's from 12 p.m. to 1 p.m. And the class closes for 1 p.m. today. The class will resume for level 1 tomorrow at 12 noon. And we'll also be having 3 classes tomorrow also from 12 noon. We'll be having ethics and professional standard that will be taken by Adiola Badebo CFA. The second class will be quantitative methods taken by Olabode Williams CFA from 1 p.m. to 3 p.m. And the last class for tomorrow will be taken by Fola Abimbola CFA, that is derivatives, from 3 p.m. to 4 p.m. So you say that we have a lot to give to you, 6 courses over a course of 2 different days. We hope you would enjoy the classes. They'll be educative, they'll be interactive, and we wish you all the best in your exam. So I hand you over to Mohammed Buba to start the class today. Thank you. And please also note that recordings of these classes and other classes will be streamed live on our YouTube channel. For the courses that won't be taken, you can go to our YouTube channel and check for those courses from past facilitators. You can access them so that they can help you in your study materials. Thank you, and have a fruitful and educative weekend.
Okay, thank you for that introduction and briefing to the bootcamp for 2025. As introduced, my name is Mohammed Buba. I don't know if you can see me. My camera is on, just to put a face to the name. If you can, just respond via the chat. Well, today I'm going to be taking you. Alternative investment. Like you know, it's a bootcamp class. We expect it to be a revision class. We expect most of you must have read. So 1 hour will not be sufficient to take you through the nitty-gritties of alternative investment. But I'll try to pinpoint the most important things for you to be able to help your preparations you've done already, so as to make the exam much easier, inshallah. So we'll go right away, and I'll be sharing my screen. I hope you can see my screen. Maybe I'll just put it on slideshow mode. Is it visible enough?
We can see it fine, but maybe putting it in presentation mode would enhance it more.
This is better, right?
Yes.
Okay, so today we're going to be talking about alternative investments. So the question that comes to mind is, why do you actually want alternative investments, despite the fact that you have traditional investment, as the name is always used, that is investment in stocks and bonds? So why would an investor, why would a CFA, potential CFA charter candidate want to learn about alternative investment? And the reasons are just these 3. These 3, when you're studying alternative investment, you have to have them at the back of your mind all the time. All the questions you're going to be having all through when you read alternative investment will revolve around these 3 reasons. The first is returns. Stocks and bonds give you returns, quite okay, but sometimes not enough. Not enough returns that you want as an investor. Maybe you have a lot of money, you are willing to take much risk. So the returns given to you by the stocks and fixed income instruments might not be enough. So you need more returns, and you can get that from alternative investment. Like you all know, cryptocurrency is part of the alternative investment, very, very risky, but gives you high returns. Real estate can give you high returns. Investment in commodities can also give you high returns. And also, investment in hedge funds and private equities will give you exposure to higher risk, but also give you higher returns. So this is one thing that you must always put at the back of your mind when you study alternative investments. The second is access to investment vehicles and investment structures. In stocks and bonds, you only have access to brokers and also the market, right? But alternative investment can give you access to real estate. Maybe you want to own a property in the US, you want to own a property in Zimbabwe. How do you do that? You can do that through alternative investment, maybe because you already have enough stocks and bonds. You want to also have exposures to other investments. Or no, you just want to have investments in very risky asset classes. You just want to have a fund manager that can trade on currency. You want to have a fund manager that can trade on equities, but not having exposure to equities market, but just to look at the ups and downs in the market to see which stocks are overvalued, which stocks are undervalued without having exposure to the market. This you can achieve through hedge fund, and that is what alternative investment gives you. The third and also important is what we call diversification. As you all know, whatever you do in the investment world, you look at it from a portfolio perspective. So you have a stock, you have a bond, you have cash, right? So the movement between these asset classes matters when you're putting up a portfolio. And I think the people who are going to take your portfolio will give you more details on that. But there's what we call correlation between assets, how they co-move. You also see that in quantitative techniques. So in a portfolio context, you have to be able to put assets that will diversify your risk. And how would they diversify your risk? By ensuring that they have low correlation. That means if stocks are going up, you might have another asset class that might be going down, right? If stocks are going down, you have an asset class that might be going up. So this, if you have a group of different assets, you are diversifying your risks. That means not putting all your eggs in one basket. So that is one benefit that alternative investment will surely give you. So the next thing we need to look at is, now let's come to the meat of it. This is the features of alternative investment. You must be able to tell these features on your fingertips if you must pass alternative investment. And these features are very important. First, you need to know that they are not regulated, they are not transparent, they have performance appraisal issues, they have low correlation. I've talked about that, and I'll give you diversification benefits. They are not liquid. For example, if you buy a property in Abuja or in Lagos, for example, if you want to sell it today, you might not get the same price, and also you might not be able to sell it quickly. So they are mostly illiquid. And also, they require a lot of money to purchase these assets, right? Also, if you want to engage a manager to invest in alternative investment, you need managers who have special skills. So there's need for special knowledge. And also the cash flow differs from the normal traditional investments. Also, you need to pay fees because you're engaging managers, because those asset classes have different requirements. So these features are very important. As we go ahead, you'll see them coming up in different alternative investment asset classes. The next thing is the categories. Before now, the categories are not categorized this way. They are different. Okay. So the categories used to be more broad, more specific than this, but now it's been shrinked into 3 main buckets. So this is also a pitfall when you're answering questions on alternative investment. Private equity is no more a category. It's under a category called the private capital, where you now have private equity and private debt. Real assets has a lot. This is where the pitfall might come. When they ask you, is real estate or infrastructure a category of alternative investment, you might be quick to say yes, but you must make sure that the category is under the real assets. So you have real estate, you have infrastructure, you have natural resources and the likes. Hedge fund remains a category on its own. So having said this, I want us to attempt a few questions to test our understanding. Put your answers in the chat and I will follow up with that. So I'll be waiting for your answers in a minute. Okay, great. I think we can make progress on this. You guys are doing well. I mean, the answer is actually B, like we said. So restrictions are a feature of alternative investments. You can have lockup periods. You want money, you need to give them a notice period of 90 days or 30 days in some cases. And real estate, like I said earlier, they are not, it's not a category, rather it's a subset of the real asset. So let's attempt this. Okay, because of time, I think we've got some good numbers. Let's review the answers. So the first one is from a portfolio perspective, which is very important for everything you do in the investment world. You have to look at it from a portfolio context. So which of the below is the least benefit? This is also a pitfall in the CFA questions. Always be careful. Least. Don't just see benefit and say, oh, diversification is a benefit, return is a benefit. Least benefit. Which one is not a benefit? Impliedly. So liquidity is not a benefit in the alternative investment space. So this other one is, so this is investment in private equity because the stocks is regulated, bonds is also regulated. So that's an alternative investment question. So the answer is C. So that's a good one. You guys did well on the first LOS. Let's take a look at the second LOS. So the second LOS, I want you to look at it from, let's say, for example, you want to invest in alternative investment and you're already a real estate investor. So it means you have expertise in real estate, but your expertise is maybe in Africa. So you are very good in Africa and you're more specialized in commercial real estate properties. So when a client comes to you and say, I want you to invest my funds in commercial real estate, I also want you to invest my funds in the residential properties, and I also want you to invest my funds in the United States of America. So you have 3 investment proposals from a client. So how do you now invest in this different investments? Which vehicle will be most suited for this kind of investment? So the first one, which we explain, is the guy wants you to invest in a commercial real estate. This is your thing. I mean, this is where you have a specialist for. This is what you are in the market to sell. Investment in commercial real estate. So in that case, what you do is you go for a direct investment because you understand the market, you understand the region, you know the regulations, you have the skills to do due diligence, and also you know the risk in the market. So you know which real estate will do, which area is better, and the likes. So in that case, you are already a sophisticated investor, a fund manager that understands that this investment, I know it, I can do it myself, I don't need a fund manager, so I will just go direct and invest in those properties. So the next investment, residential. So in this case, you have an idea about real estate, but you are specialized in commercial real estate. So in this case, you have a new asset, you have a new subset of real estate that somebody wants you to invest, or you yourself want to invest. So in that case, you will look for a manager that has exposure to those kind of investments. Then you co-invest with him. That is, you tell him, if you have an opportunity in residential real estate investment, I'm interested. So in this case, you're investing with him. You have funds in his own fund, but when there's an investment opportunity, you ask him to tell you, then you join him to see that investment. In that process, you're learning and getting better in residential investment. So that is what we call co-investment. You have an investment in a fund, and you have a manager that tells you if there are opportunities, then you invest together. So that is co-investment. That will take care of the concern of the residential real estate investment. Then the third one is investing in the US market. So in this case, you're in Africa, well known in the commercial real estate space, but you don't have exposure in the United States. So in this case, what you do is you look for a fund manager, a fund investing, and do a due diligence on different managers. The one that is very good in that space, whether either it's residential or it's commercial or it's core real estate, you get a fund manager, you put your money there, and you go to sleep. So these are the 3 forms of investment. So the first one, Direct investment means you know the business, you go direct. Co-investment, you have some idea, but you're not that good. So you get a manager and you co-invest. Fund investing, you have no knowledge. You don't want to go through that stress. You don't have the skills. You get a fund, you put your money, and you go to sleep. So in fund investing, the most important thing is getting the right manager. In co-investment is to have a slight idea and also get a manager that has the knowledge. In direct investment, you don't need the manager, so you pay no fee. You do it yourself. So what I've just explained is in these three buckets. I'll be sharing the slides so you can just have more deep into it and have an idea. So for fund investment, it's indirect. For co-investment, you have direct and indirect method. For direct investment, you're going directly yourself. So you must have control. You have high flexibility. You require a lot of skills and you must be a sophisticated investor. So let's have some questions to see if we understood what I just explained. All right. So let's have 5, 6, 7. Okay, because of time, we'll just go through the answers. I think we've got a lot of questions. Thank you. You've been active. Let's keep it up. So the answers are these. We have CCA. I think most people got it. So co-investment allows an LP to invest in alternative investment through the GP fund, indirect, and also alongside investing in a portfolio company directly. So that's co-investment. So you put your money in the fund, but your goal is to co-invest with the general partner. If you have an investment opportunity, please, I want to invest also directly. While I have some money with you, you can invest that in your fund. The second one is direct investing. Requires expertise, due diligence. I've talked about that, and high minimum capital. In this case, you are the guy that understands the market, so you just go directly. Fund investing, you don't have any experience, you just go to a fund. So the most important thing here is getting the right fund manager. So you guys are doing well. Let's keep it up. So what are the structures and ownership structure using alternative investments? So the most dominant structure is the limited partnership structure. So the limited partnership structure is simply where you have an investor and also you have a manager. That's how I'll put it. So the investor is the one who gives the money, and we call him the limited partner. He's called a limited partner because his liabilities are limited to the amount he has contributed into the pool of fund, right? The general partner, who is the fund manager, is the one who manages the fund. So in this case, you have an investor and a manager. You put your money in the fund, he manages it, you pay him a fee, and those fees, you have some criteria to ensure he earns the incentive fee, while the management fee is mostly a flat management fee. So you have a document called the Limited Partnership Agreement that governs the structure. It tells it will guide the activities of both the limited partner and general partner. And also, the limited partner, who is the investor, is a passive partner. It doesn't involve in the day-to-day running of the fund. It doesn't even have details of what investments will be done. Why the side letter is also an interesting concept, because you might have a manager that has like 10 to 15 investors, but a particular investor might say, okay, I don't want you to invest my fund in alcohol. I don't want you to invest my fund in real estate. I don't want you to invest my fund in certain constraints that he might have. So that side letter will govern that extra supplement to the agreement. So another interesting structure is the PPP, public-private partnership. This is mostly for infrastructure investment, where if the government needs financing to maybe do a railroad or do an airport, especially in emerging economies or the OECD countries, you find that private investors might come and provide financing. So they will build the airport, they will operate it, and they can transfer it back to the government. So in that case, you need an SPV, and also you need concessional agreements to say how long are you going to use it. You build, operate for a specific period of time, and also you sell it back to the government at a particular price. So this is mostly for infrastructure. Master limited partnership is just like the limited partnership agreement, except that it's more liquid. it trades in the equities market, like using the REITs and the ETF. So that's just the difference. I hope you get that. So the next and one of the most important reading is the compensation structure. So if you look at it, we already talked about the investment structure, which is a limited partnership structure, is the most dominant. So we're going to use it here. So in the compensation structure, you have the manager and you have the investor. That's the way I look at it. So, but you have to, as a candidate, you have to know the investor is always called a limited partner. But for the sake of this class, I always use the investor to make it easy. Then the general partner is the fund manager. So the management fee is often 1 to 2% of asset under management when it comes to hedge funds. You will see it clearly written 1 to 2% asset under management, and they will tell you this asset under management, is it at the beginning or at the ending? So and it's always fixed. It doesn't change once it's written. Private equity, once it's stated, it doesn't change. It doesn't have a condition. That's what I mean by fixed. It means it's 2% asset under management. Whether you make money or you lose money, you're going to earn that as a manager. Private equity fee, management fee is based on committed capital, not invested capital, right? So you commit to invest 10 million, even if you have not given a dime, you are still going to be paying what we call a management fee. So performance fee or investment or incentive fee or carried interest, as it's called, it's a periodic return of profit. So it has some conditions. You can't just sleep as a manager and without making money and continue to earn incentive fee. No, we have conditions. You have the hard hurdle rate. This hard hurdle rate simply says that whatever return you're going to earn an incentive fee must be in excess of the preferred return. So if I want a 10% return, if you make 12%, it means that you're only going to earn a return on the excess, that is 12 minus 10, only 2% you're going to earn that 20% fee. So there is need for a catch-up clause to maintain the agreed ratio. Also, there's a clause called the catch-up clause in the case of a hard hurdle. So this catch-up clause ensures that both the GP and the LP, the manager and the investor, gets the agreed sharing ratio of 80-20. That is on the profit. Everything we're going to be talking about, conditions, will always be on the incentive or the carried interest. Soft hurdle, once the hurdle is met, that is, if I meet a 10%, then I'm going to earn 20% completely on, let me see. So if you earn, in this case, once you get, sorry, if you earn the 12%, you're going to get complete 20% on the 12%. But on the hard hurdle, you're only going to get excess of 10%. That is just 2% by 20. So you can see this soft hurdle favors the general partner, who is the manager, while the hard hurdle favors the LP. Deal by deal is saying that if we have two different investments, each one is independent. That is, if deal one makes profit, I can get my 20% on that, even if deal two makes a loss. But the whole of fund says no. You have to protect the LP. You look at the entire deals as a portfolio. So you put them together. If deal one makes money and deal two loses money, you net them. And if there's a profit, you take the incentive fee. So these are some of the compensation structures that we need to know. So time is running, but let's look at one of the most important, which is the catch-up clause. Are we together? Just send me in a chat to know I'm with you. You've not lost me. No, that's the funny thing with the virtual environment. So in the catch-up clause, I just put up this to make it easy for you so you can look at it after the class. But let me just give you a brief idea of what it is. So if you make an investment at year one, and this investment is 100 at the beginning of the year, end of the year, you made one. End of the year, you make 120. So you have a return of 20%. Then the terms of agreement says you have a management fee that is independent. So it means you're going to charge 2% end of the year for management fee, and also incentive fee is 20%. And the LP gets 80%. But with the hurdle rates, this is the problem. And also the hurdle return is 10%. So this investment, as we all know, moved from 100 to 120. So it means we had a profit of 20. So the hard hurdle rate is always, you only pay return on the excess of the hurdle rate. So you made 20 and the investor wants a guaranteed 10%. So you're not going to share with him in this 10%. So 20 minus 10 is 10. So 20% will only be on the excess, and that will be 2. So that's what you're going to give the manager, right? For you as the investor is the LP, you're getting the 10%, the 10 guaranteed. Then also the difference between this, which is out of the 10 that you're going to share with him, you're also taking 80%. So in this case, this is the entire profit of 20, but it is shared 90 to 10%. So this was the practice of the hard hurdle rate. It makes the investor earn more than the general partner. So what happens is, how can we solve this anomaly? So the catch-up clause was brought into the perspective. So the catch-up says, okay, you want a 10%, no problem. We are okay with that. But we have to assume that this 10% is 80% of the return that has been earned. So in that case, we need to give the manager 20% of the return earned. So if this 10%, if this 10 is 80%, so the formula here is you take the guaranteed return, which is 10%, you divide it by the share of the LP, which is 80%. When you do this mathematically, it gives you 100%, the value that would have been if it was 100. Then you multiply to get the 20% for the manager. So in this case, it means that the original return was 12.5. So you took 10 for the limited partner, and you took 2.5 for the general partner. So we are reinstating the return, saying you want a guaranteed 10%, no problem, but we also want to catch up. We also want to earn 20%, assuming that 10 is 80% of the return. So we look for the 100% of the return, which is 12.5. Then we take 2.5, 20% of that, which is 2.5. So that gives us the catch-up. So this is always the catch-up. If you're asked to calculate the catch-up, this is the catch-up, right? So this is important. Learn this formula. If you want to cram it, it's okay, but intuitively, this is what it is. Then the remaining balance of this 10 minus 2.5 will be shared between those two parties. The manager will always get 20%, which is this, and the investor will always get 80%. So in this case, we also have shared the 20. But in this case, we look at it, the red is always for who? The red is always for the manager, while the yellow is always for the investor. So in this case, the investor has 80% and the manager has 20%. So now we have been able to bring back this initial anomaly from 90 to 10 to 80 to 20. So this is a bit, it's a very tricky concept. Most, even those above your levels, always find it a bit. That's why I put up this. So you can look at it after the class and try to understand it much better, but it's clear. And also, if you're not asked to calculate the catch-up clause, but they tell you that there's a catch-up clause and they want you to give the share between the manager and the investor, it's super easy. What you just do, forget about the hurdle and all that. Just since the hurdle has been met, which is 10%, you expected 10%, and the guy has made 20%. So it means that hurdle has been met. You just go and do the soft hurdle. That means you just take the 20, then you divide it 20% for the investor and for the manager, then 20 by 80% for the manager. So this will give you the share of each. Once you see that there is a catch-up clause, fully catch-up, and a hard hurdle rate, as long as the hurdle rate is met, forget about all the calculation of the catch-up. Don't do that. Just go directly and share them into 20 and 80, and you get the share for the manager and the share for the investor. But if you are asked to calculate that figure, this 2.5, that is when you need this formula. I don't know if I'm communicating or that is clear. Okay, let me have a reaction on the chat to let me know we are okay or you're with me on this so we can make progress. Okay, great. So that's for catch-up clause, so you can read this in more detail, but I think the explanation suffices as well. So another concept is what they call the high watermark. Very interesting concept also. You can look it up more in detail, but I'll just give you a pictorial concept of what it is. So these are investments net of fees. So this investment started at 100. It moved to 120 in year 1 and also in year 3 to 140. in year 1, in year 2 to 160, in year 3 to 140. So in this case, it means that the manager actually made money here, right? So he's going to be entitled to a profit, an incentive fee, and all of that, right? So in year 3, he lost money, right? So the investment did not do well, right? So, but in year 4, he also made money to move the investment from 140 to 180. So if you want to calculate the incentive fee at year 4, you're not going to use this 140 as the bench, as the beginning value. No, you're going to use the highest level net of fees. This is net of fees. When you do the calculation, you're going to use the highest value net of fee, and that is what we call the high watermark. So the incentive fee at year 4 would be 180. This is the ending value minus the value, the highest value ever made in that investment, net of fee, which is 120. Then you do the 20%. So this is the incentive fee that's going to earn, not this level. So because you've already paid him from moving the fund from this level to this level. So that is what the high watermark is saying. So you don't pay a manager twice for the same performance. We've paid him to this level, so when he's not going to benefit from this level. So it's only going to benefit from this additional increment in return. Okay, that is what the high watermark is saying. Theoretically, you don't pay a manager twice for the same performance, and for you to calculate it, you have to be careful. Take the value at which it has been higher in previous levels instead of the beginning value or the ending value of the previous years. So make sure it's the highest point at which the portfolio or the manager has been able to take the fund and deduct it from the ending value, and you take a 20%. Or whatever percent is given to you as required. So that is for the high water mark. So the next thing is appraisal of alternative investments. Appraisals of alternative investments are very direct. I think you have to do this more on the corporate issuers level, but I'll just tell you what we're trying to say here. Because performance appraisal is how you appraise the performance of an investment or a manager. So in this case, because the cash flows of the alternative investment is not like the stocks where you just buy a stock and you know when you've made the payments. No, in terms of alternative investment, you have different inflows and outflow structure. For a private equity, you have to commit and you have to be making funds the next 5 years, and also distributions will come much later. So the pattern of inflow and outflow of cash is not straightforward. So in that case, you have to consider that. Also, in terms of alternative investment, you use borrowed funds. This is highly leveraged, so you have a lot of borrowings. So in that case, you also have to consider the impact of leverage. The valuation also depends on the cycle, investment cycle. We have what's called the J curve, right? At the beginning, because you're just making money and paying fees, you're going to be losing in that fund. But subsequently, when you start deploying funds in investments and you start getting distributions, the returns will now become positive. So the complexity of the fee structure also and tax accounting treatment also is something to consider. The life cycle of the investment, borrowed funds, valuation of the asset, and the fee structure are key considerations of alternative investment. So talking about this is what I mean by the J curve. You see, in this case, you're committing capital. So here, and also paying fees. So the investment will be in the negative territory. When you start deploying fund into investment and start making little returns, you start having the greens. Then when this investment start making money, that is distribution back to investors, then you have a higher return. So this curve is what we call the J curve. So leverage is because leverage always magnify gains and loss, and because most certain investments, they borrow to magnify their positions by taking leverage. So you have to look at the leverage return. It's simply the total return of an investment and also the return from borrowed funds. This formula, it's key for you to understand, and also understand it from a theoretical concept. I don't think they'll ask you more to calculate at this level. So the IRR is suitable because it helps to look at the timing of cash flow. So if you must be familiar with your calculator when you go to IRR in your financial calculator, where you put the inflows and also the outflows and also the inflows. So you get the IRR. So the IRR is good for alternative investment because that's the pattern of cash flow. The MYC is simply saying if I put 10 million today into investment, how much do I get back? So if you put 10 million today and after some time you get 20 million, it means you have 2 times your investment. So it's simple and intuitively, but also you have to consider that if that 20 million was earned over 20 years, it means that it's not really meaningful. So time also matters. Valuation of accounting, just using cost because it doesn't have market valuation, so you have to estimate it at cost. And also impairment will come when you have any issues. So those are the key things you need to know. So let's try some questions and we'll make progress. Okay, so because of time, I will just go through the answers. Thank you for your responses. I can see them in the chat. Good one. So let's make progress. So the answer is A and B, right? So whole of funds and deal by deals. Whole of funds favors the LPY, deal by deal favors the GP. Committed capital and side letter. In a private equity arrangement, management fees are charged on committed capital rather than AUM or invest capital. This is to discourage managers calling for funds when there is no viable investment. So I commit to a manager that I'm going to give him 10 million, but I ask him only ask for money when you have a viable investment. So if I tell him I'm going to pay him a management fee when he invests money, he's going to call for investment even when he doesn't have a very good investment. So that's why private equity decides to put this clause that the management fee should be on the committed capital so as to help the manager always ask for capital when he has a viable investment. So the hedge fund, I will just run through this quickly. What you need to know about the hedge fund is that it's a strategy-driven fund. It's also used the limited partnership structure where you have the investor and the GP, right? So you have restrictions. We've talked about that. You're familiar with that now. So it gives you high return, diversification benefits. Also, there's flexibility. It can invest in anything. If it wants to go into the equities market, it has a zero beta exposure because it doesn't concern itself with the market. No, it concerns itself about a stock that is overvalued and a stock that is undervalued. And it can have equal positions in the beta so that it will have zero exposure to the market. Now, for the strategies, what you need to know is you have to look at the word. Event-driven means something is happening at the company level and that could create value, like a merger, right, or a distress, or an activist shareholder buying up the companies, trying to make it get value and sell it again. So something is actually happening. Relative value is a mispricing between two related securities, like a bond, a company that has a bond and equities, but those two asset classes are mispriced. They are not supposed to be mispriced. So if you realize there's a misprice, you can buy a fixed income convertible arbitrage, as buy the bond and sell the stock. Then also you have a convertible future that you can convert that bond to stock when the price goes up. So macro global is trying to say you want to take exposure to the entire economy. So you're looking at inflation, you're looking at GDP, you're looking at the currency. You have a top-down approach because you start from the economy down to the asset classes. While event-driven is a bottom-up approach because it starts from the company level. Equity hedge is every question you see talking about overvalued, undervalued within the equity spectrum is the equity hedge strategy. So at a high level, you need to understand them at a high level. Event-driven is when there is an event. Relative value, there is a mispricing. Macro global, it talks about inflation, GDP, and its top-down approach. Equity, when it talks about opportunities in the equities market by taking long and short positions. Funds of funds is another interesting concept. Instead of you going to a fund manager, directly a hedge fund because you don't have the capacity, there is what we call the funds of funds. So the funds of funds creates another pool of funds. They receive money from investors and they now invest in different hedge funds. So this gives you the participation benefit because you now have your money invested in different hedge funds. Also, you have easy access at a minimum capital. And also they can also dictate terms because they have a lot pool of funds and they can negotiate with different hedge fund managers because they also understand the business better than retail investors. But the issue is you're going to pay double fees because you're going to pay the funds of funds and the funds of funds is going to pay the main hedge fund. So you have double layer of fees as a downfall. Okay, so let's try this. Questions? Thank you, Amaka, Lamidi. Thank you. Let's keep them coming. Participate. This is where you can make mistakes and we'll correct you so that on the exam day it goes well for you. We hope so. So just participate, attempt the question. Don't worry if I'm going to get it or I'm not going to get it. This is the place to make those mistakes. Good. Thank you, Adedeji. Thank you. Yeah, thank you all. It's coming. Yeah, I appreciate that. Let's keep the answers coming. Let's make it as interactive as possible. So thank you for the answers. We'll just go direct to the question, to the answers. So it's actually C&A convertible arbitrage is like I explained, it's you go long on the company you think is gonna be it's undervalued and you short the stock you think is overvalued. So hedge funds are likely like mutual funds, but with less or no regulation, high flexibility, highly leverage, and target absolute return or high alpha. So it's a true. So let's look at private equity quickly. Private equity is simply you want to invest in a private company. That is what it is. And you have three main buckets. You have the leverage buyout. What it simply means is you borrow money and you buy out a company. Just like what Ike, the late Ike, and also the owners of Access Bank did. So they bought a bank, they made it better, and they went back to the market. It gives you sweet money when you get it right. So leverage buyout is you get a company that is not efficient, it has assets, it can pay its cash flow, you buy it, you make it better, and you go back to the IPO market. The ultimate goal for every private equity is to go either public or to exit the position at the in the future. So this is very important. Exit strategies are also important. So the leverage buyout is borrowing to buy, either you keep existing managers or you bring in new managers. And also, what are the attractive targets for a leverage buyout? So if I want to buy a company that is established, I need to ensure if I'm buying a public company to make it private, the price must be very, very depressed. And it's only because of the company is not well managed, not because the entire stock market is bad. It has lots of assets because I'm going to be borrowing, so I need to pay back. It can generate cash flow to pay the debt. It's not efficiently run, so I can make it better. The management are willing, they're not going to give me a headache, and also it's not highly levered. So it means I can be able to borrow more on the asset. So this is what you need to know. Venture capital is when you want to go for a new company, just like you have an idea, so you talk to your friends and families, they fund you. So once that idea is seen to have some feasibility, then the first time the VC, the venture capital, will come into place, it's to give you a seed capital. And you can see we have some in Nigeria like Cowrywise and other startups that have made it to light. So the seed stage is when the venture capital comes and look at your business and say, okay, yeah, there's a possibility of something to happen here. So they can give you money to develop the product and do more market research. And also early financing is when you want to start producing, and later stage is when you expand. So the attractive target is high potential for growth, not cash flow, not inefficient management. No, that company must be able to grow in the future. So vintage is also good. You don't buy a company when the economy is actually very, very doing well. So it means that company will go down when the economy is down because it's sensitive to economic cycles. So you have to look at that. Also, it has negative or low revenue. You don't expect to have revenue at this stage. You just make sure that that company will do well in the future. So growth capital is simply expanding the business, minority stake in an established company. So exit strategy, I've talked about this. The trade sale or strategic sale is when you're selling a company, like when Facebook is buying WhatsApp, or Olam is buying Dangote, or if tomorrow another company is buying Cowrywise, for example, or any of the public private companies, right? So initial public offer is the best. It gives you the highest profit, but involves a lot of cost and time. This is a new concept, SPAC. It means that the company is a public company registered, but it's just waiting for a private company that is ready to go public, and it gets that company, it buys it, and it puts it in the market. Recapitalization is not really an exit, it's just adjusting the capital structure. That means you sell it to some investors, you give them, you reduce your exposure so that you can pay dividends to the owners. Secondary sale is when you go into the business as a private equity fund, but your horizon is not looking good, so you can sell it to another private equity fund who is ready to wait. It has high returns, but also it has less diversification because the private equity market is correlated with the public market. Vintage year is the year at which you invest in venture capital. So it's good if you want to invest, you have different vintage years so that you can have diversification benefits. Okay, Let's try these questions. Okay, great. Because of time, I will just run through it. Thank you for attempting. That's good. Yes, so mezzanine stage is when you want to go for IPO. That means you want to reduce your exposure. You want to give investors a stake in your business with a convertibility feature that they can convert when you go public. So that's it. So with high leverage and target mature companies, it's leverage buyout, a trade sale. It's when you sell it to a competitor. So it's a. So that's it. CDA is the answer. So for private debt, it's lending money to a private company. I mean, this is what we see this happening now most often in the market, because the public debt market, people don't have access to it because you need to have certain high credit ratings and all that. So direct lending is when you lend to a private company directly, whether by a bank or individuals, right? But it needs to be, it's highly collateralized. You need to give some collateral, so that lowers the risk. Mezzanine, like we said, is when you're reducing your exposure before going to IPO. So it's more risky because you're close to the lower part of the capital structure. Venture debt is when you give a debt, but it's backed up by a venture capital. Okay, give the startup money, but we have, as a VC, we're going to back it up. So distress is when you get a company that is in distress, you buy the debt of that, make it better, and also you can sell it in the market. Collateralized loan, these are securitizations. You do them more in fixed income, so we don't take much of our time. So attempt the questions. Let's see if we have a fair understanding of it. Sure, you're going to have the slides. I'll try and share the slides with you. Yeah. So this is it. We have CA, mezzanine, like I said, preparing for IPO, why it has the highest level of risk. So the next thing is real assets, commodities. What I want you to understand in commodities is it gives you diversification benefit and also inflation hedge. It is not a return-driven asset class, right? So it helps you to get return from changing commodity price, not cash flow. So it's not like a real estate where you get a cash flow from rents, right? So inflation hedge is important. And also the concept of contango and backwardation. So the formula for future price, like we know, is the spot price and 1 plus the risk-free rate. That is the collateral you're going to put, plus the storage cost, because you're going to keep that commodity in a store, minus the convenience, which simply means the value of the need for that commodity now. So if the need of that commodity is high now, the convenience will be high. If the need for that commodity is not high, the convenience will be low. So it means that convenience yield is inversely related to inventory levels, because if we need a commodity now, everybody's going to buy it. If you don't need it now, it's available, nobody's going to keep stock of it. So the contango is when the futures price, given this formula, is greater than the spot price. So it means that the commodity is not needed now more. It's needed more in the future, so you have to pay for storage and the convenience yield is low. Backwardation, it means the commodity is highly demanded now, so the convenience yield is high, so the futures price is actually low, and the storage cost is also actually low too. You can also have access to the futures market, which is liquid and transparent and aid price discovery. So this is what you need to know on the commodities. For land, timber, and farmland, they are illiquid, definitely. You can't sell a land easily. And also they have low correlation with traditional investment. And also you need to look at the condition of the physical land if it's a land. For timberland, it has option value. So you can either harvest or not harvest. It has ESG benefit because of the carbon monoxide that it produces. And also location and transportation creates value. So if the timberland forest is accessible to roads and all that, you can easily sell it. Farmland gives you different crops, helps you hedge inflation because of the crop prices. And also it doesn't have the option of flexibility. It can also be affected by weather as well. So that's for commodity, that's for natural resources. For real estate, you should know residential real estate is the most largest sector in the market. Real estate are not liquid, they're illiquid. And also they give you tax benefit by non-cash depreciation and tax deductibility interest expense. So it means that tax deductible interest expense. So it means if you buy a property today, you can charge depreciation and also the mortgage interest that will reduce your taxable income. There's a pitfall sometimes. They don't put non-cash, they just put cash depreciation. So it's always non-cash because depreciation is not a cash item. A disadvantage of investing in direct investment is that we have the huge capital that you need specialized knowledge. It's also very complex. So another important thing is the core real estate strategy and core plus value add and opportunistic strategy. Core is always a stable income. That means you get a property in a location that people like the office real estate where you have full vacancy and also the income is stable. Core plus is you have a property that you need to do some redevelopment to make it better. Then there's some risk there and higher returns. Opportunistic is the property is actually dilapidated. You need to bring it back to life, fix it, and that gives you a higher return. So this you see it in the slide. So infrastructure, it's another important concept. So infrastructure is a real asset. It's long-lived. It gives you income stream. That's one of the important, and also inflation hedge, and also it matches your long-term liabilities. You have categories, economic and social. So it either generates income or it takes care of social concerns like healthcare and education. So the lowest risk for this category is the secondary stage because it's a fully completed, no expansion required. The brownfield gives you stable income. It's also low risk because it's a regulated industry. While the greenfield has construction risks because it's a new infrastructure that is going to come to the market. Direct investment requires a lot of money. Indirect investment can be done through ETF and REITs. These are risks that are associated with infrastructure investment. You can read them on your own. So the last one is the digital asset. So for the digital asset, what I wanted to look at is just to look at an asset that is everything about this asset is electronically done, right? So when you see it can be created, stored, and transmitted completely electronically, right? So like the cryptocurrencies, the tokens, and the digital collectibles, right? So this aspect is completely electronical, so it means that there's no physical asset involved. And the two major ones are cryptocurrencies and the tokens. The cryptocurrency is the Bitcoin. So this cryptocurrency is just talking about the form that you can use it as a medium of exchange. It means you can buy something with this coin. That's the Bitcoin. And the altcoins are other coins like the stable coins. This is just saying you have a coin that is backed by a group of asset classes, a basket of other currencies, just to make it stable. So the asset is backing it. Central bank digital currencies are also your money, but in digital form. These are not really like Bitcoin. They are actually fiat currencies, but they are in digital form, right? You can remember we used to have it in the Central Bank of Nigeria where we have the e-wallet. So the tokens are non-fungible tokens, security tokens, and utility tokens. But for the sake of your exams, you have to understand the digital ledger technology. The digital ledger technology is simply saying you have a platform that is decentralized, that is secured within the blockchain. The blockchain technology ensures that people can carry out the transaction electronically. It will be chained and becomes immutable. That is, you put the transaction, you execute the transaction in a digital platform. All the members of that transaction, all the members in the computer, we have to encrypt this transaction. That means we are 10, we are 15, we all have a say in that transaction. And once it's blockchain and added to other earlier blocks, it becomes immutable. Nobody can change it. So you have two ways of solving this, encrypting these transactions. Proof of work is solving the algorithm by all the miners. While proof of stake is you have few people who call the validators to do this. Then permission and permissionless means that you need permission to be a validator or a miner. In permissionless network, you don't need a permission to do that. Another important thing is the futures of digital asset from traditional investment. The digital asset does not have value on its own. It means that the value is driven by expectations. Today, if the Nigerian government says we're going to, or the Zimbabwe government or any other African country says we're going to be using cryptocurrency for paying tax, the value of crypto will go up. So, but it doesn't have a value in its own like gold. Validating transactions, because of its decentralized, it's a DeFi using cryptocurrency, and also it gives people that security that I'm the one controlling my transaction. It creates value. And also limited in supply also gives value to cryptocurrencies or digital asset. Also, if it's accepted as a medium of exchange, it creates value. And also, if the law regulations accept Bitcoin today, it will also create value. But on its own, it does not have much value. I know we're running out of time, or we're almost at the nick of it. So the next thing is the investment vehicles. How do I have access to digital currencies? One, you can do it directly by investing in Bitcoin or cryptocurrency, or you use a wallet on application website. You can also do it on a regulated, centralized platforms, or decentralized like Bitcoin, not regulated. So indirect investments, cryptocurrencies, ETFs. Another thing you need to know, it has high risk and high return. Also, because it has low correlation with the traditional investment, like you can see lately, Bitcoin has been going up and down, but the market remains the way, slightly less volatile than the Bitcoin. So that gives you diversification benefits and also regulatory risk. I think will stop here. That's the end of the slide. Others are questions that are in the slides. You can also have access to them when I share the slide. I just want to say thank you for listening, and your participation was quite appreciated. I wish you all the best in your exams. For level 1, what you need to do is do as much questions as you can. Do as much questions as you can. Practice a lot of questions. You can always reach out to us for the exams if you have any issues. I'll also post some questions on the calculation, because we can do it here. You can also refer to and well detailed. So I want to say good luck to everyone, and thank you to the society for organizing the bootcamp. I wish you all the best. Thank you.
Thank you, sir.
Bye-bye. Thank you.
Thank you very much, Mohammed. The next class starts with economics, and Damilare Ojo is on call to take the class. Damilare, over to you.
Thank you very much. Good morning, everyone. And I'm just going to share my screen shortly. So I believe you can hear me, and we'll just go straight into it. We have just 2 hours for economics, so we'll do as much as we can within the time that we have. Okay. So please just confirm that you can see my screen in sharing mode.
We can.
Okay, awesome. So as I said, we are going to look at economics. We'll try to cover as much as we can within 2 hours, and I'm just going to go straight into it. We don't have much time. Starting with the firm and market structures. What we've done is to try to highlight the learning outcomes. Someone's mic is unmuted. Okay, so the learning outcomes, but I'm not going to dwell so much on them. It's just to give us a perspective into what we need to do. Short down, break-even points, characteristics of different market structures that we have, and looking at their supply and demand curves. And as we move along as well, we are going to try and solve some questions, just as was done in the first session taken by Mohammed. And just to add to what he said when he was closing, that what you need to do for level 1 is to solve as many questions as you can. And I just want to lend my voice to that point that I mentioned. Okay, so what I've tried to do here is to just dimension the 4 categories of market structures that we have. Of course, we have more than these 4, because these 4 just focus on the supply side. There is also the demand side, where you talk of monopsony, oligopsony, and whatnot. But for most market structure sessions that you have, we typically focus on the supply side, and that's what the CFA the CFA curriculum has also tried to do. So I've tried to aggregate so on this slide you have an aggregate of some of the main features that are common to all the 4 categories of market structures that we have. So one of the things that they want you to know based on the learning outcomes as well is that every firm maximizes. No, I'm on market structure snapshots. I don't know what you can see now.
Okay, we can see just the first. What I can see is the first slide.
Okay, I'm going to reshare.
Thank you.
Okay, stop sharing, share. Let me just share my entire screen then. Okay, can you see the market structure snapshot? I can see the chat box, so I would need someone to talk.
Yes, we can see the market
Okay.
structure snapshot.
Okay, great. Thank you. So, like I was saying that what you have here is a snapshot of the four major categories and the common factors to all of them. So one of the things they want you to know is that every firm maximizes profit where marginal revenue equals to marginal cost. That's one of the fundamental things that anybody needs to know when you are doing a reading on market structure. It doesn't matter whether it's a perfect competition or monopolistic competition, oligopoly or monopoly. All firms maximize profits where the extra revenue you get from selling one extra unit, which is marginal revenue, equals to the extra cost that you also spend to make that one extra unit, which is marginal cost. So marginal revenue, the additional revenue equals to the additional cost, which is marginal cost. But this can slightly vary. The way you mentioned this can slightly vary depending on the markets that you are looking at. But this MR equals MC is common to everybody. The second one is that profit is calculated as total revenue minus total cost. I think that is very straightforward. It's just sometimes you might be given the information based on average, on an average basis. So average revenue and average cost, and then you have to multiply it by revenue. So you know that your total revenue is average revenue multiplied by quantity, while your total cost is average cost multiplied by quantity. So when you subtract total cost from total revenue, you get your profit, which is the same thing as saying average revenue minus average cost, everything multiplied by quantity. So you just watch out depending on, if they give you a question like this, you have to watch out for how the question was presented. So you don't just say average revenue minus average cost and you might see the answer there and that will be wrong as your profit. And for every firm to break even just means that you have zero economic profit. In economics, we typically say that economic profit is different from accounting profit, right? So economic profit is total revenue minus total cost. And when we say a firm breaks even, it simply means that the aggregate revenue you are getting is equal to the aggregate cost that you are also that you are expending. And economic profit includes what we call it includes some costs that are not necessarily out of pocket, essentially. So we have what we call explicit costs, we have what we call implicit costs. So accounting would typically just look at the explicit costs and not consider the implicit costs, which we also sometimes call opportunity costs. So in economics, you consider both explicit and implicit costs. Okay, so a firm should continue producing in the short run if even if it's earning negative profit, but unavoidable fixed costs are covered. What this is simply saying is that in the short run, you don't just say a firm should shut down based on, negative profit. Even if the firm is earning a negative profit, as far as its price is able to cover its average variable cost, the firm should continue producing, So when you are looking at the short run decision of a firm, you don't consider unavoidable fixed costs. Sometimes you have what we call sunk cost, right? So unavoidable fixed costs are sometimes called sunk costs. So there's nothing you can do about those costs. So it then means that you don't need to consider them when you are making production decision. What you need to look at is, are you able to cover your variable cost or those fixed costs that you can avoid? If there is any that you can avoid, are you able to cover them as well? But if there are unavoidable fixed costs that you are not able to cover, it doesn't matter. You don't consider those kind of costs when you are making your production decision. And we say a firm should shut down in the long run if marginal revenue is less than marginal cost. It means Just think of it in, let's put figures to this. Let's say your marginal revenue. I don't want to say naira necessarily because we have different people on the call. I mean, so let's just use dollar, which is generic. Let's say your marginal revenue is $10, and then your marginal cost is also 10, right? At the point where both of them are equal, we say that you are maximizing your profit, so you should produce at that point. But if the extra revenue that you get is less than the extra cost, so you spend more, on a marginal basis, you are spending more than what you are receiving, then it does not, you would advise that firm to shut down. It's not profitable to produce at that point, or for any firm to produce at that region. Okay. The next one says firms may earn excess profit in the short run, but low barriers to entry will lead to a zero economic profit in the long run. Now, this point applies to markets where you have more than one players, right? So if there is no barrier to entry in a market, right? Even in monopoly markets, one of the distinguishing features of monopoly, which I'm just tempted to mention at this point, is that there's typically barriers to entry. But let's assume that there's a monopoly market as well, where there is low barrier to entry. In any market whatsoever, if there is low barrier to entry, then in the long run, the firms cannot continue to make excess profits. Even if they make excess profit in the short run, what is going to happen is, because of that low barrier to entry, the excess profit in that short run is going to attract more firms, new firms to that market. And since barriers to entry are low, they can easily come into that market and also try to, take advantage of that excess profit until that excess profit is zero for everybody. And in the short run, if firms are currently making losses, what would happen is some firms that might not be able to cope with that loss are going to have to leave the market if there's also low barrier to exit, right? So as more firms leave that market, the competition it becomes lower, it reduces, and what then happens is the firms that are in that market will be able to earn zero economic profit. Underlying point is that if there are low barriers to entry, in the short run, it might be possible for firms to earn excess profit, but they can't earn excess profit in the long run, given that there is low barriers to entry, because more firms are going to come into the market and compete away the profits, right? Okay, so the next point is saying that a down sloping long run average cost curve means that firms are enjoying economies of scale. Okay, think of economies of scale as the benefit that a firm enjoys from maybe expansion, or from being with other companies within the industry, or in a maybe industrial zone, that they spread some costs, they share some costs together, so that cost for each firm is lower than what the firm would have spent if it was on its own. So that I'm just trying to run through this point, but I mean, there's tendency to lose us on some point. So I'm going to just try to slow down a bit on this one. So you have your long run average cost curve. Typically, it is U-shaped. So you have the downward sloping portion, you have the minimum portion, which you call the minimum efficient scale, and then you have the upward sloping portion. So the downward sloping portion is what this bullet point is talking about. When your long run average cost curve is reducing, which means it is downward sloping, it's reducing as quantity increases. You say a firm is enjoying economies of scale. It means that the cost per unit of producing is reducing as output increases. Unlike where you have diseconomies of scale, firms can grow so big that it then becomes difficult to monitor activities. It becomes difficult to monitor sales. It becomes difficult to monitor even cost. And there might be some redundancies. Maybe you are paying some workers that don't even have that don't have any work to do anymore, or maybe some activities are beginning to cannibalize other activities. I mean, there can be different things like that, so that when sometimes firms can grow so big that it becomes just difficult to manage production activities. In that instance, the more you produce, the higher your cost is going to be. So you say that the firm would be experiencing diseconomies of scale at that point. But at the point where your long run average cost curve is downward sloping as you produce more, you talk of economies of scale. That's a very important economic concept to be aware of. Okay, the next one is, I think I've already mentioned that, the point where you have your lowest long-run average cost curve, we call that minimum efficient scale. It means the firm is minimizing its average cost per unit, okay? And last one, I've also mentioned it, this economies of scale, which is the upward sloping region of the long-run average cost curve. All right. Please confirm that my slide has changed to the next one, where you have peculiar factors. Sorry. Can someone confirm, please? I just want to be sure so that I cannot see the charts. I'm not sure. Okay,
Yes.
I can see. Okay, great. Thank you. So I'm just going to move on to the peculiar factors to each market category now. So perfect competition. You have many buyers and many sellers. That's one of the unique features of perfect competition. Products are identical. You can think of a market in Nigeria where, maybe tomato seller is the easiest thing to think about, right? You go to the market, you want to buy tomatoes. The tomatoes of Mama A is not different from the tomatoes of Mama B and of C and D and whatnot, right? So you have many of them in the market. What they sell is the same. Essentially, it is identical. So it means no singular firm is going to have control over price. So firms have no control over price in a perfectly competitive market. So in that instance, we say the suppliers or the firms are price takers. So they take the price as determined by the forces of demand and supply. Okay, the implication for this market, the fact that firms have no control over price implies that price is going to be equal to marginal revenue. Remember, we established one of the points that is general to all markets is firms maximize profits where marginal revenue equals marginal cost. Remember, that is the same for all the categories of that we have here. All firms maximize profit where MR equals MC. But in a perfectly competitive market, because price is constant and price equals marginal revenue, you can restate that rule as price equals MR. So you're just replacing MR with P. Remember, it is MR equals MC for all firms, but we can restate it only in this market as price equals marginal cost. So you can see a question that says, which of the following is true of perfect competition? And the only thing you are saying that makes sense is firms maximize profits where price equals MC. And you are thinking, is that correct? Is that not correct? Because you are used to marginal revenue equals marginal cost, right? Which is common to all markets. For perfect competition, because price equals marginal revenue, you can restate that rule as price equals marginal cost. The profit maximizing rule can be restated as price equals marginal cost. Please, I would implore you to take note of that point. It is only peculiar to perfect competition because it's only in this market that price equals marginal revenue. And the reason price equals marginal revenue is that price is constant. Firms are price takers. They have no control over price. So whether they want to sell more or they want to sell less, they have to sell at the same price that has been detected by the markets. Okay, so that also flows into the next point, which is the fact that firms earn zero economic profit since there is free entry and exit, and there's free entry and exit in this market. So we already mentioned that before. Where you have free entry and exit, firms can only earn zero economic profits. If they are earning excess profits in the short run, more firms are going to come in and compete away that excess profit so that they are going to then eventually earn only zero economic profit. Okay, I'll take a brief pause on that just to let those points sink in. Just a few seconds and I'm going to move on. Okay, So again, we don't have much time. Right. So for monopolistic competition, some of the distinguishing factors are that there are many, this should be many buyers and sellers. Just as you have in perfect competition, you have many buyers and sellers in this market as well. But what is mostly unique compared to perfect competition is that you have differentiated products. Remember, I mentioned tomato the other time. So if you go to the market, the tomato of one seller is not different from that of the other one. So that's perfect competition. But where you then begin to bring in branding, you begin to try to manipulate the psychology of your consumer such that they begin to see one product as being different from another. So take an example of say your toothpaste, right? You have Colgate, you have Dabur, you have there used to be Maxam. Is it Maxam? I think so. I'm not sure if they are still operating now. There is also Close Up. I don't know if I've mentioned that. There are different products. There's Oral-B as well. Different products. There there are a number of them in the market, but even within each firm, they try to tell you this is Colgate Maximum, this one is Cavity, this one is Cavity Max, this one is that Herbal. They try to make the difference, paint it as being different in your minds, in the minds of consumers, right? So we call that differentiated product. So this is one of the unique factors that describe monopolistic competition. In this market, price is greater than marginal revenue because firms can sell more by reducing price. I'm going to take this and go back a bit to what we said about perfect competition, right? Remember, in perfect competition, firms are price takers. They don't have any control over price. So they can't sell more by reducing price. That's in perfect competition. A firm cannot sell more by reducing price because the price is determined by forces of demand and supply. If one firm reduces price, other firms are going to reduce price as well. So it is demand and supply that determines price in that market. But in monopolistic competition, and we are going to see a similar feature for oligopoly and monopoly as well. In these other three markets, that's three other than perfect competition, that's monopolistic competition, oligopoly, and monopoly, firms can actually sell more by reducing price. Firms can sell more by reducing price. It then means that price is going to be greater than marginal revenue in these three markets, right? In perfect competition, price equals marginal revenue. That is why we could restate that profit maximizing rule as P equals MC. I'm just trying to emphasize these points because they are very key concepts to market structure and to what they want you to learn based on the learning objectives or learning outcomes. Okay, so firms in monopolistic competition, oligopoly, and monopoly can sell more by reducing price, but a perfectly competitive firm can not sell more by reducing price. It cannot work for perfect competition, but it can work for the other three categories. So it then implies that for these other three categories, price is greater than marginal revenue, right? So you just stick to that MR equals MC rule for profit maximization. Okay. One of the things I'm trying to do is to see whether we can finish with all the slides, if possible, by 11:30 so that I can take some questions for the last 30 minutes of the session. Okay, so let's just bear that in mind so that if you have any questions, you can note them. Hopefully time permits us. Okay, so moving on to oligopoly, you have few buyers. So unlike perfect competition and monopolistic competition where you have many buyers and sellers, in oligopoly, you have only a few of them. There are not much of them, right? You can think of the telecommunications industry in Nigeria, but focusing on telecommunication is too broad. So if you focus on voice service providers, because when we say internet service providers as well, there are quite a number of them as well. But if you just focus on the broader ones, you have large firms that control a big share of the market, and then you have smaller players that are not so popular, or depending on the sector that you operate in, right? So you have MTN, you have Glo, you have Nine Mobile, and you have Airtel. Those are the four prominent ones as far as telecommunications, or more specifically internet ISPs is concerned in Nigeria. So you can say that you have few sellers in that market. Price war. If anybody is familiar with when MTN just came to this market during the era of Obasanjo as the president, I think 1999 or 2001 thereabout, the price was so high, a lot of people couldn't afford that, to buy data or to buy airtime at that time. But as more firms came in, I think it was it Glo that first, came in as competition. Glo came in with a lower price, or whoever it was came in at a lower price, and MTN had to match their price. That is a very important concept we need to note under oligopoly. There's something called price matching. When a firm reduces price, other prices try to match that. Other firms also try to match that price reduction. But when a firm increases price, the other ones typically ignore increase in price, because what happens is, if you increase your price, the price of your own product, then people are likely to switch to other producers, especially if switching cost is low, right? But if you reduce your price, you are going to get customers of other firms, and they don't want that. Your competitors don't want you to steal their customers, so they are also going to reduce their price to match your own price. So that's one of the things that happens in this oligopoly market. So because of this price behavior, the nature of the demand curve is not so straightforward, because when price is reduced by one firm, other firms match that price reduction. But when a competitor increases price, the other ones ignore that price increase. So we have the concept of the demand curve being kinked, right? You have a kinked demand curve in this market. That's just because of the nature of the competition, whether firms match price or they ignore the price increase. And as I said earlier, price is also greater than marginal revenue in this market. So firms can sell more by reducing price. Okay, I've emphasized that, and I said that this point is not relevant for perfect competition, because they are price takers in perfect competition. They can't sell more by reducing price, but for these other three categories, firms can sell more by reducing price. Okay, just taking a brief pause on that as well. And lastly, we have monopoly, where you have just a single seller, and the seller can influence both price and quantity. One thing I've not said, on monopolistic competition and oligopoly, is that firms can not, typically influence price and quantity. They can have competitions amongst themselves, but that is just within the firms. But in monopoly markets, the firm can influence both price and quantity. But we also need to know that there's a caveat to that. It cannot influence both at the same time. The firm cannot sell more and it cannot want to sell more and also want to increase price at the same time. No, you can't increase price and expect that you also sell more, because you can't influence both. You can influence one and leave the other variable for the market, the demand side of the market now, to determine. For instance, if the objective of a monopolist is to sell more, all he needs to do is to reduce its price. So if a monopolist reduce price, it can use that to influence quantity, because one of the principles of economics is people respond to incentives, right? So if you want to sell more, you want to incentivize your buyers to buy more, you can reduce your price. But if the objective of the monopolist is to increase price, then what you can do is to reduce his own quantity. So if he reduces quantity, remember, prices are determined by the forces of demand and supply. So the lower the supply, the higher the price, all things being equal. So if a monopolist wants to sell more, remember, all he needs to do is to reduce price. But if he wants to increase price, he will need to reduce price. It can influence both price and quantity, but it cannot influence both at the same time. It can only influence one at a time. Okay, I hope I'm not too fast for us to grab this point, but I'm just trying to also lay emphasis on some of those points so that they can sink in. Okay, so This third bullet point I've already explained that. So it has significant influence over price, as I've explained. Price is also greater than marginal revenue. I've also mentioned that because it can sell more by reducing price, and there's high barrier to entry in a monopoly market. Okay, so those are the major points that I think we need to take out of this particular part of the reading. And then there are some questions that I would like us to just go through. I know people will be popping their answers in the chats, but I'm using the I would have to be switching screen so that I can see what responses people have in the chats box. So for question 1, what would be your answer? They said the marginal revenue per unit sold for a firm doing business under conditions of perfect competition will most likely be, the first session. During the first session, Mohammed also emphasized that you should please be careful with when when the question says most likely, least likely, this question says most likely. So the marginal revenue for a perfect competitor will most likely be what? Is it equal to average revenue, less than average revenue, or greater than average revenue? I'm going to go into the chart now. So A is equal, B is less, C is greater than average revenue. So let me see what's happening in the charts. Okay, I can see A. Okay, A. Yes, that is correct. Remember that in this market, for perfect competition, price is equal to marginal revenue. Okay, so the other thing you then need to know or learn from here, in case you don't know already, is that anywhere you see average revenue is the same thing as price. Price is the same thing as average revenue, right? So just get that. So marginal revenue equals average revenue. So for question 2, a profit maximum is least likely. This is least likely to occur when A, total cost is minimized, B, average revenue is equal to marginal cost, C, the difference between total revenue and total cost is maximized. I take the question again. A profit maximum is least likely to occur when, okay, I hope we've seen the options. I'll switch to the chat box to see what we are saying. Question 2, A. Okay, it seems everybody is agreeing on A. Okay, so 2, profit maximum is least likely to occur when ATC is minimized. Okay, so why is A the answer? Now, if you look at B, marginal revenue equals marginal cost. That is a given. We emphasize that. C, the difference between total revenue and total cost, which is profit, is maximized. It's already telling us that you already have maximum profit. So yes, our natural answer is A. And to just put more context into that, yes, we said where my average total cost is minimized, that's where you call your minimum efficient scale, right? But it does not necessarily mean that that's the same point where you have your maximum profit, right? So what's important for maximum profit is marginal revenue equals marginal cost. Yes, so you are all correct. Thank you. 3, the short-run break-even point of production for a firm operating under perfect competition will most likely occur when, so they're asking us for break-even point here, right? So is it where price equals average total cost, where marginal revenue equals marginal cost, or where marginal revenue equals to average variable cost? Where do you have short-term break even? P equals ATC, MR equals MC, MR equals AVC. Which one is the correct answer? Let's see what people are saying. 260 messages. Wow. Okay. I'm not sure if that's for this one. Right. So I can see somebody said A, another person, some people are going for A, some people are going for B. Okay, so we have a bit of differences in opinion about this particular question. Okay, so let's all take that again then. So we are asked for a break-even point, most likely, right? The question is most likely occur when, so break-even. When you say break-even, it means the firm is earning zero profits, right? I think I mentioned that earlier, where we talked about the general points for all the common factors for all the markets, right? So when you say break even, you are making zero profit, which implies that your total revenue equals your total cost. That's what it means. If you are earning zero profit, it means total revenue equals total cost, which is break even. But we don't have total revenue equals total cost in any of these options. But remember, total revenue is price times quantity, and total cost is average cost times quantity. So which means if you divide total revenue by total revenue by quantity, what you get is average revenue or price. And if you divide total cost by quantity, what you get is average total cost. So the correct answer is A. The correct answer is A. Marginal revenue equals marginal cost. Option B is only for profit maximization. Please, let's get that distinction between profit maximization and break even. So profit maximization requires marginal revenue to marginal cost, which is option B. So if the question had asked us for where you maximize profit, B would have been correct. But in this instance, what they are asking us for is short-term break-even point. A is the correct answer based on this question because they're asking us for break-even point. I hope that is clear to those that chose B before. I hope that's clear to everyone. Okay, some people are already answering question 4. That's great. That's great. So a market structure characterized by many sellers with each having some pricing power and product differentiation is best described as what? So let me see the answers again. So you have A, oligopoly, B, perfect competition, C, monopolistic competition. So you have many sellers with each having some pricing power. Okay, so what are people saying? C, C, C. Okay, yeah, there's a consensus on that, and that is correct. C is the correct answer, monopolistic competition. Okay, so if they have told us that the firms do not have pricing power, then we would have gone for perfect competition. But we are told that you have pricing power and you have product differentiation. So that makes C the correct answer for this particular question. And the last one on this slide, a company doing business in a monopolistically competitive market will most likely maximize profits when output or quantity is set such that, okay, let's do away with the noise and see what they're asking us. They're asking us monopolistic competitive market. So one of the things I encourage you to do, I mean, just as a passing point, you can have a lot of noise in a question. Like this one, there's a lot of noise. Just pick the main point. So the main point, the market they are dealing with here is monopolistic competition. They are saying the firm will most likely, you have to be careful with the most and least likely. So here, most likely maximize profit when quantity is set such that, okay, so where does a monopolistically competitive firm maximize profits? That's what they're asking us. So A, average cost is minimized. B, marginal revenue equals average cost. C, marginal revenue equals marginal cost. So where does a monopolistically competitive firm maximize profit? Is it where average cost is minimized, or where MR equals AC, or where MR equals MC? What are we going for? C, 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 C. Yes, that is correct. I believe nobody would have a different opinion regarding that. So MR equals MC is correct. Okay, just to lay emphasis on one point again, if this question was for perfect competition, you might not see MR equals MC, you might see price equals MC, or you see AR. Remember, price is something as AR, right? You might see AR equals MC. That is correct. That would have been correct for a perfectly competitive market. You know, in a perfectly competitive market, price is the same thing as average revenue, is the same thing as marginal revenue. So you can restate that rule as instead of MR equals MC, you can restate it as P equals MC or AR equals MC. Those are some of the tricks that come with some of the questions that you might encounter. Okay, that brings us to the end of this particular part of the the first session. Okay, so we'll go into the second one, and which is understanding business cycles. And so the learning outcomes are just three. They want you to understand business cycle and its phases, credit cycles, describe how different things, or economic indicators are, described or measured under this, or how they fare under different cycles. But I just try to bring out what I think are the most essential things in that particular reading. So what are business cycles? They are recurring expansions and contractions. One thing we know about any economy is that you can't continue to have growth over time. You cannot continue to have growth. There would always be moment of growth, moment of slowdown, moment of contraction, moment of being at the trough, at the least point of economic activity, and then you have moment of growth again. So that fluctuations would always be there. If you look at economic growth, historical growth rate of every economy whatsoever, no country has growth, or nobody has growth rate increasing forever. You would always have moments of increase, moments of decrease, moments of even negative growth, and it's so that recurring expansion and contraction in economic activity is what we refer to as business cycle. It's a cycle, ups and downs, ups and downs. That's the way I like to think about it, right? Ups and downs in economic activities. That's business cycle. And then we have 4 phases that the CFA Institute wants us to be aware of based on the curriculum. You have the recovery phase, you have the expansion phase, slowdown, and contraction, right? So the 4 of them, you have them here. So what is the recovery phase? So at some point, the economy is at its lowest point, which is called the trough. After that lowest point, what you would expect is gradual increase in economic activity. So economic activity will pick up and begin to increase. That's essentially what a recovery phase is. So it says the economy is going through the trough where actual output is at its lowest level relative to potential output. So you have actual output, you have potential output. 2 important concepts to also be aware of. So actual, as the word implies, is what the economy is actually doing. So if we say Nigeria's GDP today is so number of of trillions, right? That is the actual. If we say Nigeria's GDP, based on the labor force that we have, based on the machineries that we have, based on whatever that we have, the human capital that we have and whatnot, this is what we are supposed to be doing. Maybe we are supposed to be doing 20 trillion naira, or let's say we're supposed to be doing 40 trillion naira, but we are actually doing about 18 trillion naira, that kind of thing. So what we are supposed to be doing is a potential based on the economic resources that we have. But what we are actually doing is the actual. I mean, obvious from the name, right? So when actual output is at its lowest point and is relatively lower than potential outputs, or lowest relative to the potential, you say you are at the trough. Okay. So when second point now, it says economic activity is below potential but starting to increase, that's recovery, right? Trough is that lowest point, but when it's now starting to increase, that is what you call recovery, starting to increase. But you still have a negative output gap, which begins to close. When you say output gap is simply the actual output minus the potential output. So remember I said the other time, let's say the actual output is 18 trillion, but our potential is actually 40. We have a potential to do 40, but we are doing 18. The difference is 18 minus 40, which is negative 22, minus 22, right? That is the negative output gap that we are referring to here. So the difference between your actual and your potential. So when you're at the trough, definitely actual is at its lowest point and is lower than potential. So you have a negative output. So, but when that negative begins to close, it is still negative, but it begins to reduce from 22, minus 22, it reduces to minus 20, minus 18, minus 15. It begins to reduce, right? It begins to close. That is what you call recovery. And when you say expansion, which is the next phase after a recovery, outputs increases and rate of growth is above average. So when you then have increase in outputs, you call that expansion, and actual output rises above the potential, right? So you are reversing it now. So potential is still 40, but actual is now maybe 41. So you have an expansion. In some instances, we say the economy is already overeating at that point, right? The economy is overeating because we are producing more than our potential. Maybe people are working extra hours, people are, working extra time. Producers are sweating all the resources they have to produce as much as they can, right? And then prices and interest rates may start increasing. Remember, I just mentioned overeating. When the economy is overeating, you have prices increasing, right? And then inflationary pressures begin to surface in the economy. Those are the features of expansionary phase of the economy. And then you have a slowdown. After the economy has overheated, then at some point, output reaches its maximum relative to potential, and then growth rate starts to reduce. Remember, you can't continue to grow forever. So at the expansion phase, growth rate is increasing. At the slowdown phase, growth rate is reducing. Please be conscious of when we say growth rate reducing versus growth or versus output reducing. There are two different things, right? Output is the actual number. So let's say what we are doing is currently 18 trillion naira. If we move from, okay, if I use those abstract numbers, it might not be so clear. So let me start from maybe 10. If I move from 10 trillion to 15 trillion, my output has increased by 50%, right? It has added 5. So I was coming from 10 trillion naira to 15 trillion naira. I've increased by 50%. If I move from 15 to maybe 25, the growth rate now is less than 50%. So the economy output is still increasing, but the growth rate has reduced. That is what you have in a slowdown. So if you have a growth rate of, say, 10%, from 10%, you then have a growth rate of 8%. From 8%, you have 7%. It is still positive, but it is reducing. The growth rate is reducing, right? That is a slowdown. It is different from the growth rate being negative, in which case actual output would have reduced, right? So which is what defines the next phase, which is a contraction. Okay, I hope that distinction is clear to everyone. I'm going to take it again in case anybody missed out on any point. I was trying to help us distinguish growth rates, increasing growth rates from increasing output, or changes in growth rates from changes in actual output. So if you say growth rate is increasing, you have an expansion. If you say growth rate is positive but reducing, it is still positive but it is reducing, that is a slowdown. When you then say growth rate is negative, that is a contraction, right? So they might give you a table on the exam, and what you see is growth rate, reducing from maybe 10% to 7% to 2% to 1%. It is still positive. It means output is still increasing. But what is only happening is the rate of increase in output, which is the growth rate, is reducing. That would be a slowdown. It is not a contraction. Please don't be confused. That thing gets many people confused, and it can easily make people lose marks if questions like that come up, right? If growth rate is reducing, although it is still positive, that is a slowdown. But the moment you have a negative growth rate, that is what you call a contraction. I hope that that point is clear to everyone. I'm just trying to somebody is asking about the materials. Yes, I believe they'll be shared. Okay, so next one is contraction. I've already said period after the peak. Peak is the highest point of economic activities. So the economy has already reached its peak, and then you begin to have negative growth. negative growth, which means output is then beginning to reduce. So you can also, this is also called a recession. So you can hear recession, recessionary gap. A recessionary gap is simply the same thing what we call output gap, negative output gap before, right? During the when we talked about recovery, I mentioned negative output gap, which is the last bullet point on that. So recession means contraction. It means output is beginning to reduce. And if recession is severe, if the contraction is very severe, that means it takes a prolonged period of time. You call that a depression, right? I believe some of us might have come across the concept of the era of the Great Depression of the late 1920s to 1930s, right? Which is where one of the prominent figures in economic literature, John Maynard Keynes, came up with some of his theories that we still make reference to in economic, in economic conversations today. Okay, so recession is simply a period of prolonged, depression is simply a period of prolonged recession, or you call that a severe recession. Okay, so consumers and businesses begin to have lower confidence in the economy. One of the things that is monitored by every economic policy maker in the world, or every serious economic policy maker, maybe I should put that caveat, is business and consumer confidence based on their expectation. Are they confident in the economy? Are they confident the economy will come out of this, maybe a gloomy period or in a negative period? What do they think would happen to output? What do they think would happen to maybe exchange rates, to inflation, those economic variables? So when you have business and consumer confidence declining, you call that a contraction. Okay. CFA also wants us, based on the curriculum, they want us to be aware of key indicators in, when we are talking about business and credit cycles. And we have three of them. We have leading indicators, we have coincident indicators, and we have lagging indicators. So when we say leading indicators, these are indicators that tell us ahead of time what the economy is likely to do. In today's language, you can say maybe a fortune teller, essentially. If you have an economic indicator that is a fortune teller that can tell us ahead of time where the economy is headed, that is what you call a leading economic indicator. So the point here says their turning points usually precede those of the overall economy. They have value for predicting the economy's near-term future state. So if you have a question that says which of the following indicators, or which of the following has a predictive value for the economy's near-term states, those are leading indicators. They tell us ahead of time what the economy, or where the economy is headed, essentially. And some of them are a stock market. The performance of the stock market can tell us what kind of confidence people have in the market. So if the stock market activities are increasing, the stock market index is increasing, it is positive over and over, over a period of time, then it can tell us that, people have a very positive confidence about the economy, and it's more like a what do you call that now? Something that predicts itself. I've forgotten the term now. A self-fulfilling prophecy. Yeah, that's what I'm trying to remember. A self-fulfilling prophecy. So if people have that confidence about the economy and they begin to have higher retail sales, house prices are increasing, consumer expectations are positive, that tells us that the economy is, likely to experience higher performance or positive performance in the nearest future. So those are leading indicators. When we say coincident indicators, the second one, those are the ones that their turning points coincide with that of the economy. They are very close to those of the overall economy. So it's more like they are happening at the same time with economic turning points. When we say turning points now, it just means when the economy is moving from one phase, you have four phases, from one phase to the other phase. Those are turning points, right? Okay, so it says they have value for identifying the economy's present state because they are just coincidence. So you only have the present state, right? So industrial production index, for instance, in Nigeria, the CBN used to track. They used to give what we call the purchasing managers index, the PMI. So that's an index that can tell us where the economy is. At the moment, real personal income, manufacturing and trade sales, those are coincident indicators. Then you have lagging indicators, which is the economy had already experienced its own turning point. Then these indicators are more like backtracking or tracking from behind the economic indicator. So their own turning points take place later, after those of the overall economy, right? So they are believed to have value in identifying the economy's past condition. And the examples are lending rate, inventory to sales ratio, and loans outstanding. So they just want you to know some of these indicators so that if a question comes on them, you'll be able to say, yes, this is a leading indicator, this is a coincidence indicator, and what are the key features. So we said leading indicators help us to predict the economy's what is likely to happen in the economy in the near future, while coincidence tell us where the economy is currently, and lagging tells us what the economy has already done or has already gone through. Okay, that's the end of that second part. Based on the points that I just tried to bring out for the time that we have. I think we are doing well on time. So we'll move on to the next one, fiscal and monetary policies. Let me just look at the chat in case there are any questions or anything. But let's just keep our questions to the end. And okay, so fiscal and monetary policies. So these are two different readings, but I've tried to bring them together because we don't have much time, and just try to put them side by side. There are a lot of learning outcomes that we need to know based on the fiscal part and the monetary part. They want us to be able to compare both of them, describe the roles and objectives of central banks, know which tool is used for which policy. Fiscal policy is different from monetary policy, and to also understand the interaction between the two policies. Okay, so the first slide on that reading is just giving us a snapshot of the two policies side by side. Who uses fiscal policy or who controls fiscal policy? It is a government essentially, and the central bank or the apex bank or monetary authority controls the monetary policy. So in some countries it's called central bank, or more generically we just say apex bank, right? Or some countries use monetary authority, because what happens is that in some economies, in some countries, the central bank or the apex bank is different from the monetary. Sorry, what have I done? It's different from the monetary authority. Okay, so but we just need to know that fiscal policy is used by government, while monetary policy is used by an independent body, or a body that is supposed to be independent, right? A supposedly independent body. Okay, so the main tools of fiscal policy are taxes, government revenue, and transfer payments. So you have these three major categories, and under each, of course, we have different examples. But broadly, you say government revenue, which is taxes, government spending. Of course, government earns revenue from more sources than just taxes, but for most economies, government revenue, taxes typically constitute the bulk of government revenue. That's why we just say taxes or revenue. And then you have government spending and then transfer payments. And then for monetary policy, the key or the main tools are money supply, or sometimes called monetary aggregate. You have credit and you have interest rates. Okay. What are the main objectives of these two policies? Generally speaking, for both of them, whether fiscal or monetary, the overall goal is to ensure that they promote growth, right? To ensure stable economic growth. But it then becomes a bit of nuances around the terminology or how you coin that for each of the two policies. So for fiscal policy, we say the objectives are to influence economic activities or promote growth, as I've just mentioned. Wealth and income redistribution, which is where you have transfer payments. Transfer payments are sometimes used for redistribution of income. And taxes are also used for redistribution of income. Same thing with resource allocation between different economic agents. So when government wants to redistribute resources or to allocate resources from onset, they can use taxes, they can use government spending, they can use transfer payments. So what government needs to do, if it wants to allocate resources to a particular sector of the economy, all it needs to do is to maybe increase its spending to that particular sector, right? So if you look at the budget or the conversations that the current government is talking about, they are very big on infrastructural development. So they want to improve Nigeria's infrastructural development. So you would expect them to allocate a lot more resources to infrastructure than to other sectors of the economy. That's just the way it is, right? For monetary policy, the main objectives are to ensure low and stable inflation, or we say stable price level. It's not for you to have zero inflation necessarily. It's just for it to be low and stable. Please, you need to also be mindful of that, because sometimes the questions can be tricky, or the answers, options you have can be tricky, and you have an option that says the objective of monetary policy is to ensure zero inflation. Nowhere do you have zero inflation as an objective. I don't think any country or any central bank has that as an objective, to have zero inflation. No, inflation itself, to some extent, is not bad. Is a useful economic we talk of twin economic evils, inflation and unemployment. In economics, we call them twin economic evils, right? Inflation and unemployment. But the point is, for inflation, you don't necessarily want to make it zero, because it also has low inflation, also has its own benefits, right? But that is when you go into deeper economic conversations that you begin to look at economic theories around that. But the point that we need to be, what we need to be aware of here is that zero inflation is not an objective of monetary policy. What is the objective is stable price level, or you say low and stable inflation, not zero inflation. Please watch out for that in case you have questions like that in the exam. Okay, and of course, the second one, which I would say secondary, is stable economic growth. And then we have expansionary and contractionary policies, both fiscal and monetary. So when you say expansionary fiscal policy, or any expansionary policy, is a policy that is aimed at improving or increasing economic activities, right? So any policy, whether fiscal or monetary, now I'm just talking on a blanket, generically rather. So expansionary policies are policies that are enacted to or implemented to make sure that economic activities increase. While when you say contractionary policies, there are those that are intended for the economy to slow down. Maybe the economy is already overeating. Remember, after your expansion phase, where we talked about business cycle, right? After your expansion, you have your slowdown. So expansion, economy is overeating, and then you want to make sure that the economy slows down. What you would do there is a contractionary policy, whether fiscal or monetary. So what does expansionary fiscal policy entail? It entails higher government spending relative to its expenditure. So higher relative spending, right? Relative to its revenue. Sorry, that's what I mean. So higher spending relative to revenue or taxes. So when government is spending more, when transfer payments are increasing, or government is increasing transfer payments, you call that expansionary policy. When government reduces tax, whether direct or indirect tax, you call that expansionary policy. Because when you reduce taxes, maybe let's say personal income tax, for instance. So if government is reducing your personal income tax, it means that your disposable income is going to increase, and then you can buy more, you can spend more on the things that you spend on. So it's intended to increase economic activities, whether consumer spending, production spending, and whatnot. And then on the flip side, you have no, not on the flip side now. For monetary policy side, you have expansionary monetary policies entailing a reduction in the interest rate and an increase in money supply. So if the monetary policy, let's say Central Bank of Nigeria, for instance, reduces interest rate rather. If the central bank reduces interest rate, what they are trying to encourage is borrowing. They are trying to make sure that people borrow more, maybe to expand business activities. People can get loans at cheaper rates. So that is going to increase money supply eventually, maybe increase credit. Remember, credit is one of the main tools of monetary policy, right? Okay. So those are expansionary policies. Then on the flip side, the contractionary part, you have for fiscal policy a major tool under contractionary policy is budget surplus, right? I didn't mention budget deficit under expansionary. So when you say budget surplus, it means your revenue is more than your spending. Think of government earning more than it is spending. Or think of yourself, right? You earn, let's say, 50,000 naira in a month, or let's be, I don't know, I'm just using very low number, right? So you earn 50,000 naira, and what you spend in a month is accumulatively, on everything, maybe 30,000 naira. So you have a surplus of 20,000. It's the same thing we are talking about here for government. So don't look at this concept as being abstract. No, they are not abstract. So you can just think about it, personally. If what you spend is lower than what you earn, that is contractionary. Okay, so you have a surplus. Okay, and then if government reduces spending or increases taxes, it's same thing we are just saying contractionary. But on the other side, for expansionary fiscal policy, you have budget deficit. So if you are spending more than you are earning as an individual, you earn 50,000 naira again, but what you are spending each month is 70,000. That 20,000 difference must be coming from somewhere, whether there's somebody that is sending it to you, maybe your parents, maybe your friend, whatever, or you have it in savings before. You are, reducing your savings. You are spending more than you are earning. That is expansionary. When you think of it for the government, that is expansionary. Okay. Then when you go back to contractionary monetary policy now, contractionary monetary policy, this entails reducing money supply. So remember, contractionary policies are meant to reduce economic activities, to make the economy to slow down. So the monetary policy rather is trying to reduce money supply, and they can do that also by increasing interest rates. So if you have an increase in interest rate or you have a reduction in money supply, you call that a contractionary monetary policy. If you have an increase in government spending, I want people to type now. So I'm just saying something that is not necessarily on the slide. So I want to see your response. So if you have increase in government spending and reduction in government taxes, what kind of policy is that? Is that contractionary fiscal or expansionary fiscal or contractionary monetary or expansionary monetary? So I'll take that again. Government is spending more than it is earning. So government is increasing its spending and reducing its spending. Okay, expansionary fiscal policy. Thank you. Yeah, that is correct. So I'll go back to the slides. Okay, thank you for your participation so far. This slide is just telling us, this slide and the next will just tell us more about each of the policies. So the fiscal policy tools, we've mentioned them before. You have expenditure, transfer payments, and revenue. So when you talk about the main tools of fiscal policy, you have capital expenditure, you have recurrent expenditure, you have transfer payments. Okay, what are capital expenditures? Capital expenditures are spending on infrastructural projects or long-term projects, capital projects, bridges. Government is building bridges. Government is building roads. They are constructing new hospitals. They are building new dams, water dams. They are building, increasing the electricity capacity or generating capacity of the economy. Those are capital projects, right? Those are capital expenditures. But recurring spendings are, spending that happen every year. You can't do without them. For instance, you'll pay salaries to government employees every year, or in fact every month. So they have to make budgetary allocation every year for that. Those are recurrent expenditures. You can also think of debt service. Although in Nigeria's budget, we try to segregate debt service from recurring expenditure, because debt service might not necessarily be recurring. It depends on how much debt you have, whether you have debt or you don't have debt, as the debt increase. But I mean, if we look at it broadly as well, we can also bring it in here as part of recurring, because there's typically government, budgetary allocation for that every year as well. At least for the fact that we have borrowings, and I think all governments in the world have some borrowings. Okay, then transfer payments. You have, these are payments that are just meant to redistribute income, if you like. Okay, so you have unemployment benefit, you have tax credit, you have job search allowances. I'm not sure we have any of this anyway in Nigeria. I mean, we have tax credits in Nigeria, yeah. We have that. We have what we call pioneer taxes. We also have, tax credits based on some activities of some sectors. For instance, I know that Dangote, I don't know if they still have it today, but at some point, at least, I know that they used to have tax credit, because what then happens is government is trying to incentivize corporates as well to do something. So they give you tax credits based on you've built a road somewhere that leads to your production factory and whatnot. So yeah, these are just transfer payments. To just say these are activities or government tools that are used to redistribute income or to allocate resources. So for government revenue, you have direct taxes, you have indirect taxes, but more than just the examples, they want you to know what happens, which one can you easily change, which one can the government easily change, which one is easy to adjust. Indirect taxes are easy to adjust. So if you have sales tax, you can go to a supermarket. I don't know which supermarket cuts across Nigeria. I think people know about ShopRite, regardless of the state they live in. So if you go to a ShopRite, for instance, you can see your sales tax maybe at 7% today. Tomorrow, if the government brings up another policy and says we are increasing the sales tax, or your VAT, we are increasing it from 7.5% to a 10%, for instance, every supermarket, everywhere you buy stuff from, they are going to update it immediately to that 10% once it has been approved, duly approved and signed into the law, right? Okay, so indirect taxes are easy to adjust, right? They are easily deployed to achieve social changes. If you come to the other side, the direct taxes, they are not easy. They are not as easy to adjust as indirect taxes. Okay, so they take longer implementation time. They have longer implementation time, and there are some things that are not on this slide as well that I think we should also be aware of. We have what we call, when government brings out its policies, generally we have what we call lags in government policies. So there are lags. There is the recognition lag, there is the implementation lag, and there's a third one that just talks about the lag before the government sees the impact of that policy. I forgot, it skipped my mind now, but I mean, you can look at those as well and recognize that. So if government brings a new policy today, you are not going to see the effect of that policy immediately. It takes some time. So this is something that we are just, using to describe a direct tax, to say there is that implementation lag for direct tax. It takes some time before they typically are able to, is able to implement them. And then you have 4 attributes of a good tax system. It should be simple. That means people should be able to know what tax. There shouldn't be any ambiguity as to, is my tax 10%? Is it 15%? Is it 50%? Let me know. There should not be complications around tax, which is one of the things that we've had in Nigeria for the longest time, because you have different types of tax. You have taxes from the federal government, you have taxes from the state government, especially for business SMEs. You have taxes from the local governments, you have taxes from, different angles. So, but a good tax system should be simple. People should be able to know how much tax they are going to pay or they are liable to pay. It should be efficient, and efficiency simply means that the cost of obtaining that tax should not be more than the amount of tax. So remember, I mean, imagine that the government is expecting a tax of 100 million naira, but they've already spent 200 million to get 100 million. That's not efficiency, right? It should be fair. It should not be it should not disadvantage one group, whether social group or whatever group or income group over another. Okay, so it should be fair to everyone, and the revenue should be sufficient to achieve the purpose. And then moving quickly, just looking at time, moving quickly to the roles of central bank and monetary policies. Please, if you have any questions, begin to put them together or put your thoughts together so that we can be efficient with the time that we would have for some questions. Because truth is, we are not able to cover everything in 2 hours. So I'm just bringing out the point that I think are, most relevant for us to be aware of. So there might be some specific questions that you have in mind that I might not have been able to cover. So please would make some, even if it's 20 minutes, we'll try to take as much as we can. Okay, so roles of central bank and monetary policy tools. On the left-hand side of the screen, you have the roles of the central bank. There are 6 of them. Monopoly supplier of the currency, right? So it's only the central bank that supplies currency. You have the lender of last resort. So if the government has tried to lend and they cannot get what they want, then they fall back to the central bank. We have what we call ways and means in Nigeria, right? It is the window through which the federal government borrows from the central bank, although there are some regulations around that. You also have that same lender of last resort, even if it's a bank as well. A bank, some banks, I mean, you have what you call interbank window, where banks lend from themselves, as they borrow from themselves rather. So if a bank is trying to borrow money, for maybe it is low on cash and customers are requesting for cash withdrawals, it can quickly go to the interbank market. If it cannot get as much as it wants at the interbank market, it can also go to the central bank. So it is a lender of last resort. It conducts the monetary policy typically, right? Central banks conduct monetary policy, although in a few countries, you have the central bank or the apex bank different from the the regulator of the banking industry, different from the monetary policy conductor. But what you typically have is that central banks typically have a team, within the central bank that might also include members of the public, not just members of the public, general public, but based on certain criteria. Like in Nigeria, you have academia, you have, I think that you have different people from different walks of life based on what the Constitution has said, that constitute the Monetary Policy Committee, the MPC in Nigeria. So, but just saying, monetary policy conduct is typically done by the central bank or its agency, as the case might be. You have supervision of the banking system, which I think I've just mentioned in passing. You have regulator and supervision of the payment system, right? You have the banking system, you have the payment system. Central bank also regulates and supervises that. And then you have the banker to the government and the banker's bank, which feeds back into lender of last resort, right? So the federal government of Nigeria has an account. I mean, the primary accountant, or what do you say, the primary bank of the federal government is the Central Bank of Nigeria. So it is this cuts across not just Nigeria. I'm just using Nigeria as an example. So the central bank is the banker to the government and the banker's bank. All commercial banks, not just commercial banks, deposit money banks, can also be merchant banks, whatever. All of them have accounts with the central bank. So just as you and I have accounts with, maybe our GT bank or our First Bank or our Zenith or Access or whatever bank you use, all banks also have their accounts with the central bank. And then Moving to the other side quickly, the tools of monetary policy, you have open market operations. These are very important tools that we need to be aware of. Open market operation, also called OMO for short, OMO. Official policy rates, which could have different names in different countries. In Nigeria, we call it the monetary policy rate, MPR. It used to be called the discount rate at some point in Nigeria a long time ago. In other countries like the US, for instance, called the Fed fund rate, the Federal Reserve Bank, fund rate. Different countries have different names for it, but in England as well, it's called the bank rate. But official policy rates, whatever name it is called in different jurisdictions, and you have reserve requirements. These are the three major tools of monetary policies. So what is open market operation? It is simply buying and selling or trading of government securities between the central bank and typically commercial banks, or say it can be the public, but typically the central banks, because they are the ones that warehouse money for the public in any way. So you can have open market sales, you can have open market purchases. So a purchase is when central bank is buying securities from commercial banks. I'm just restricting the conversation to commercial banks, but like I said, it can be more than just commercial banks, right? So when the central bank is buying government securities from commercial banks, what do you think would happen? So what happens is central bank is going to pay them, right? It is buying. Just think of it logically. So it's a purchase. Central bank is buying securities from banks, from commercial banks. It pays them. What happens is the amount of money they have at their disposal increases, and then they are able to lend more to the public, all things being equal. So that would make me ask a question. What do you think open market purchases is? Is it a contractionary monetary policy tool or an expansionary monetary policy tool? Open market purchases, where the central bank is buying securities and crediting the account of commercial banks, is it an expansionary monetary policy tool or a contractionary monetary policy tool? Okay, expansionary. Yeah, thank you very much. Did somebody type expansionary fiscal? Is this? I hope it's not for this particular question. So, open market operation is monetary policy, not fiscal. So it's an expansionary monetary policy too. And the other side of it is open market sales, where the central bank is selling securities to commercial banks, and then it means it is mopping up excess liquidity. We call it, it's trying to mop up excess liquidity in the economy. So when will a central bank, I want you to type again, when will a central bank use an open market sales? Is it when it is is it when there is inflation or when there is low growth? I'm giving you two options. A is there is inflationary pressure, or when there is low growth. When do you think they will use open market sales? Is it inflation or low growth? Okay, somebody says low growth, somebody says inflation. A lot of people are saying inflation, but I see at least one person said low growth. So at least for the sake of that person who has been bold enough to type and said low growth, I'm going to another person has said low growth. So let's take it again. It means this is not so clear. So open market sales, maybe either you didn't get my question well, or it wasn't, the explanation is not clear. So I'm going to take it again regardless. So open market sales involves the central bank selling securities to commercial banks. Now think about it. When it sells securities to commercial banks, what then happens is it takes money from them. If you sell something to somebody, you get money from the person. So central bank is selling securities to commercial banks. It takes money out of them. What happens to their ability to, the amount of money they have to make credits, it reduces, because they now have, commercial banks now have less money with them when the central bank sells securities to them. So central bank is selling to them. It is taking money away from them. Then they have lower money to make credits. It then means that central bank is going to do this only when there is inflationary pressure, which is why we said it is it is done intended to reduce money supply growth. I hope that is clearer to those that said low growth. The question I asked was, when will the central bank use an open market sales? It will use it when there is inflationary pressure, not when there is low growth. It uses it to achieve low growth. It uses it when there's an intention to reduce growth, to reduce money supply growth or economic growth. We won't necessarily say economic growth when there is overeating in the economy, right? So it wants to reduce money supply growth. That's when it uses it. But when does it use it as well? It is when there is inflationary pressure, and then the intention is to reduce money supply growth. I hope that is clearer to those that said low growth earlier. Okay, then we have official policy rates. If it's not clear to you, please, during the Q&A, I'm still watching the time. You can ask me again so that I can explain that better. Okay, so the official policy rate, like I said, in Nigeria, it is called the monetary policy rate. It can take different names in different countries. And essentially, the central bank or the monetary policy authority sets this rate to influence economic activities, particularly credit and prices, right? So this policy rate determines how much commercial banks are going to lend to people, or how much rate rather they are going to charge you when they are lending to you. So imagine today Nigeria's MPR is around 27.5, if I'm not wrong, almost 30%, right? 27.5 or so. And then if you go to a commercial bank, how much do you think they're going to charge you as interest rates for them to lend you money? They're going to charge you, a rate that is higher than the monetary policy rate, right? And then what happens? So maybe, for instance, they might charge you 35% based on the fact that the monetary policy rate is currently 27.5%. They might charge you 35%, right? But imagine if they then reduce, if central bank reduces that monetary policy rate from 27.5% to say 15%. Let's say it drastically reduces for whatever reason, or over time it reduces to 15%, right? What happens? Commercial banks won't charge you 35% again. Maybe now they will charge you 20% or 22% or 23%. So the higher the official policy rate, the higher the rate that banks are going to charge, anybody that wants to borrow money from them, whether it's individual or businesses. What then happens is when commercial banks increase their lending rates based on the fact that official policy rates are also higher, money supply is going to reduce because the amount of credit, people will not be able to get so much credit. Higher interest rate is going to discourage people, whether individuals or businesses, from borrowing money. All right. So you can then think about, when will official policy rate be increased? When will official policy rate be increased? Is it to achieve expansionary monetary policy or contractionary policy? Right? So when will official policy rates in Nigeria, for instance, when will the central bank increase the monetary policy rates? Is it to achieve expansionary policy or contractionary policy? Contraction. Thank you very much. Yes, that is correct. And the last point here is reserve requirement, where the main thing that we have here is money creation process is more powerful the lower the percentage reserve requirement of banks. What does this mean? The central bank requires banks to keep a certain percentage of their deposits in an account with a central bank, right? So in a reserve account, if you deposit for every, let's say, 1,000 naira that you deposit, for instance, the commercial banks are required to set aside a certain amount. In Nigeria, it is called the cash reserve ratio. So the cash reserve ratio, I think it's currently around 27% as well, 27% or so in Nigeria. I think so, or we can double check that. Or let's just assume it is 27%. It means for every 100 naira, or I said 1,000 before, yeah? For every 1,000 naira that you keep in your account with your commercial bank, the commercial bank is required to keep 27, a minimum typically, a minimum of 270 naira out of every 1,000 you keep with them, they are expected to keep 270 naira with the commercial bank. Okay, so imagine if reserve requirement is then increased from 27% to 50%. It means that for every 1,000 naira you keep now, instead of 270 naira, they're expected to set aside 500 naira. You see, the higher the reserve requirement, the lower the the commercial banks have with them to supply credit. So if the central bank wants credit to reduce, all it needs to do is to increase, or one of the things it can do is to increase the reserve requirement. And if it wants credit to increase, it can also reduce reserve requirements. I hope that is clear to everyone. So these are three main tools of monetary policy conduct. Yeah. Okay, inflation targeting. I think I'm not going to dwell too much because of our time, too much on this. But I think, yeah, I just wanted to know that inflation expectations mostly are of more concern, of more interest than even the current inflation. So if inflation is currently, Nigeria's inflation is currently say 25%, 26%. What people are expecting inflation to be in the nearest future is of more interest to the central bank than what it is currently. Do people expect inflation to increase in the future? Do they expect it to reduce in the future relative to where it is currently? That is of more interest to monetary policy conduct than the current state of inflation, because I think that this is one of the major points they can test people on in the exam. That which of the following, I don't know, whichever way they says the question, I'm just hypothetically saying which of the following will the central bank consider or most likely consider when it is setting its monetary policy. This puts you current inflation, past inflation, inflation expectations. Please, expectations is more important than even the current. Okay, and then we talk about these are the features of a good inflation targeting framework. I don't have so much time to explain inflation targeting, but just know that a good inflation targeting framework should, for it to work, the central bank must be independent and credible. It must consider a wide range of economic and financial market indicators. The central bank must be committed to transparency. There must be a clear, systematic, and forward-looking medium-term inflation targets. This is just saying, if you want to target inflation, what are the key ingredients? What are the key features? Central bank must be independent and credible. In Nigeria today, you can argue whether people still, people believe the central bank, both Nigerians and foreign investors. But I think that under this current administration, I mean, we might all agree that investors' confidence is beginning to increase because the central bank is committed to more transparency. There's more communication. People see it as being more credible. Although people can still argue, but at least compared to the, maybe the past, for instance. So these are some of the things that you look out for when you are doing inflation targeting. So I will just move quickly to the interaction between fiscal and monetary policies. I think this is also something highly testable, just to say, okay, if you have easy fiscal policy and easy monetary policy, what happens? If you have tight, one is tight, the other is easy, or the two are tight, what happens? So just think about fiscal, when you think about everything, think about how does it affect the government spending and how does it affect private sector spending. That would give you a clearer picture. So when you have easy fiscal policy and tight monetary policy, easy fiscal policy means government is spending more, right? That's expansionary, essentially. Government is spending more. And tight monetary policy means that there is an increase in interest rates. And if there's increase in interest rates, what happens? People have less money, supply reduces, private sector demand reduces. But remember, we have easy fiscal policy, which means government is spending more. But on the flip side, because of monetary policy that is tight, private sector demand is lower. It then means that the effect of this combination of easy fiscal policy and tight monetary policy would be that government spending, sorry for the typo error, government spending as a proportion of aggregate income is going to rise. Government spending as a proportion of aggregate income is going to rise when you have a combination of easy fiscal policy and a tight monetary policy. Okay, when you switch sides and go to tight fiscal policy and a an easy monetary policy, the opposite is going to be the result as well. So you are going to have private sector share of GDP increasing at the end of the day. And then when both of them are easy, so government is spending more, monetary policy is also, reducing interest rates such that money supply is increasing, then you are going to have higher aggregate demand both from the fiscal side and from the private sector. Then you have inflationary pressure resulting from that combination. Then, of course, when both of them are tight, you're just going to have a lower aggregate demand at the end of the day. And I think we have a few questions here. We still have, this last interesting topic that is also, I think, is even going to take much more time, but let's see. Let's run on this. So with respect to fiscal policy, transfer payments are best described as what? So are they welfare payments, infrastructure spending, or spending on recurring goods and services? So which one is our answer, A, B, or C? Okay, 1A. Thank you. Yeah, that is correct. So fiscal transfer payments are welfare payments. Question 2, a fiscal policy tool that can immediately influence spending is most likely, emphasis on some of those things. Fiscal policy tool that can immediately influence spending is most likely what? So indirect taxes, exchange rate targeting, or capital expenditure plans. So which one is our answer? 2A. Thank you. That is correct. Indirect taxes, remember we said they can be easily manipulated, unlike direct taxes. Okay. If a government increases its spending, that's question 3, on domestically produced goods by an amount that is financed by an equivalent increase in taxes, the aggregate demand will most likely. Okay, this question brings us one of the concepts that we didn't have much time to talk about, which is government balanced budget multiplier. Just note that when government increases expenditure by the same amount as the increase in tax, right? So what happens is the multiplier, when we say multiplier effect, it means like a domino effect. So the recurring effect of an activity. So government has increased its expenditure. How does that affect different sectors of the economy at the end of the day? That's what multiplier simply means. So government expenditure multiplier is greater than tax multiplier. The spending multiplier is greater than the tax multiplier. What that implies for this kind of question is that when both of them, spending and tax, are changing at the same time in the same direction, we know that even if it's not in the same direction, the influence of the change in spending is going to be more than the influence of the change in taxes. The government spending multiplier is greater than the tax multiplier. So the effect you would have from a change in government spending, is going to be higher than the effect of a change in tax. So if you break this question down, increase in government spending, if it increases aggregate demand by, let's say, 1%, an equivalent increase in tax. So if taxes increase, it means aggregate demand is going to reduce. Remember, increase in tax is a contractionary policy, while increase in spending is an expansionary policy. So you're having two conflicting policies now. So increase in spending, expansionary; increase in tax, contractionary. So which one would have a higher effect? That's what this question is asking us. But because we know that government spending multiplier is higher than that of tax, so it means that the effect from increase in spending is going to be higher than the effect of increase in tax, so that at the end of the day, you are going to have a net increase in aggregate demand. I hope that is clear to everyone. We are going to have a net increase in aggregate spending. I hope that's question 3. So the answer is going to be C. The answer is going to be C. Okay, next one, which of the following statements is most accurate? I would like to see some response on this. An increase in budget deficits is always expansionary. An increase in spending is always expansionary. The structural deficit is always larger than the deficits below full employment. Okay, which is most accurate? Increase in deficits is always expansionary. Increase in spending is always expansionary. Which one is correct? Question 4. Somebody said C. I can see C. I can see B. I'm not sure how this chart works now. It just keeps jumping. Okay. I can see A, B, C. We have the three answers. That can be correct. Okay. So we need to talk about this then. So when you have increase, let's just first look at C. When you say structural deficit, it's just looking at more like the growth rate. So you are looking at the how is the growth faring over time, right? So when you say structural deficits is always larger than the deficits below full employment, it doesn't even have any bearing with what we are talking about here. So we can discount C. Okay, so let's go to B. An increase in government spending is always expansionary. I mean, true, government spending is increase in government spending is expansionary, but is it always the question? I mean, the option says always expansionary. If you have increase in government spending, we don't know for us to conclude that it is expansionary, we need to know what is happening to tax as well. Just look at the question we just finished solving in 3. It says government has increased both spending and taxes. So is that necessarily expansionary? So if you have increase in government spending, yes, it is expansionary, but is it always? We don't know what is happening to tax relative to the increase in spending. So we can't entirely say B is correct because of the word always. A says an increase in deficit is always expansionary. That's actually correct. So a budget deficit, remember, is government spending being greater than the tax, right? So if government spending is greater than tax by say 50 this year, 50, maybe 50 billion this year, by next year, government spending is greater than tax by 150. It says the increase in deficit has increased, right? So an increase in deficit is always expansionary. That is absolutely correct. So the answer is A, because it says an increase in deficit. It does not even say just deficit. It's an increase in the deficit is always expansionary. It means the increase in government expenditure far outweighs, is the difference is bigger between government expenditure and taxes. Okay. So please let's take note of that. So the answer to question 4 is A. And the last one here, which of the following best describes the overarching long-term objective of most central banks? Is it price stability? Is it fast economic growth? Is it current account surplus? Which one is the answer to question 5? I think there's a question, yes. But did we not say that government spending multiplier is greater? It has jumped again. Oh my. I'm not sure. Okay, it's come again. So did we not say that government spending multiplier is greater than tax multiplier? Yes, that is correct. Even if tax is reduced, will that still not make the economy expansionary? Okay, the point here is we don't. So if tax is reduced, yes, it is expansionary. But what if tax is increasing as government expenditure is also increasing, and the tax is increasing by a larger amount? Why this in question 3, why we said increase is the answer is they said the change is equivalent. You can see the word equivalent. That's a keyword, equivalent. We don't know that the increase, we know that the increase in tax is not more than the increase in spending. It's just equal. So why B is wrong for question 4 now is we only know that government spending is increasing. We don't know the relationship between the increase in government spending and the change in tax. I've said change in tax because we don't even know if tax is increasing, or it is reducing, or what is the magnitude of the change. But if it's increasing, is it increasing by a larger amount than the increase in spending? So when you look at these different relationships, you would have different answers. So that is why B cannot be correct for question 4. I hope that is clear to Peter. Yes. Okay, great. He said you understand now. Awesome. So question 5, A. I think A is the only option we have here, and that is correct. Price stability. Okay, we have, wow, 17 minutes more, and this topic is in itself will take a lot of time. But let's see, it's a very important topic. But I think I'm going to maybe skip this slide. Let me see, what's the most important thing to say here? So all trade restriction policies lead to higher prices for everyone. I don't know how best to explain this without going into much details because of time. But if we just note these points, this keynote, I think, I think the slides will be shared so we can go through them and just pick what is most important, because I think the exchange rate calculations is one of the most testable topics. So we'll just have, I think, 3 slides there and we'll be done. So just key concepts here, just breeze through them. The spot rate is the rate between, the conversion rate between a currency, 2 pairs of currency essentially today. So you can say naira to dollar today is 1,500, that's the spot rate. When you say forward rate, 2 market participants have agreed to a transaction in the future, and they're saying, okay, the spot rate is 1.5. Let's agree to make this transaction in 3 months' time. I will make it for 1,450. 1,450 instead of today's 1.5. We'll make that transaction in 3 months' time or 6 months' time. That's forward rate essentially. The rate they are agreeing on today for a future transaction. Okay. Interest rate differentials is simply the differentials in 2 interest rates. So because you are dealing with exchange rate here, naira to dollar, for instance, and you're also considering what is the difference between Nigeria's interest rate and that of the US. So the difference is what we call interest rate differentials. Maturity of forward contract, like I said, if they say 3 months, we are going to enter this transaction in 3 months. That's your maturity. The cross rates, here where you have 2 currencies that are not expressly quoted and you're trying to walk back. So let's say, for instance, you have naira to dollars and you have dollars to pounds. Let's assume, I mean, definitely we have a naira to pounds exchange rate, but let's assume that we don't have that naira to pounds exchange rate. What we have is naira to dollar and we have dollar to pounds. We can walk back, we can multiply both of them to get naira to pounds. That's a cross rate. So you are looking at 3 pairs now, right? But your objective is to get the rate between 2 pairs, 2 currencies, 1 pair rather, two currencies that are not expressly quoted. So you are then bringing in a 3rd currency to help you to walk back. So remember here we are interested in naira to pounds, but what we have is naira to dollar and dollar to pound. So we can multiply both of them to get naira to pounds. And then triangular arbitrage. It happens when there's an opportunity to benefit from differentials in cross rates between 3 currencies. So just imagine that, okay, yes, we definitely have naira to pounds, but let's say that when you look at your naira to dollar versus and then your dollar to pounds, you see that the rate there is lower than if you go and buy naira, go and buy pounds directly. So you have dollars, you want to buy pounds. So you are looking at, okay, what is the exchange rate between naira and pounds? You don't have that directly, but you have naira to dollar, you have dollar to pounds, and you are seeing that there's a difference when you do that cross rate and when you do the rates directly. And then if there's a difference, you can either sell one currency and buy the other, and just make a trade to benefit from that differential. It's something we can all read up on more if the concept is not entirely clear because of our time, but it's a very important concept to be aware of. Okay, tricky question. So currency calculations are typically fun, and I have a pro tip for us. So when you are thinking of currencies, I think the easiest thing to do if you're a Nigerian is to think of naira to dollar, right? Whatever pair they give you, just think of it as naira to dollar. And whatever country you are from as well, whatever the major pair, maybe Ghana cedis to dollar, for instance, you can think about that and say, okay, let me make it simple for myself, right? And do it that way. These questions we have are going to take a lot of time. We have 13 minutes more maximum. Let me see. let's just answer from this first part. Number one, can we answer this? Is the euros expected to appreciate or depreciate against the USD in 1 year? So we have the rate, the pair USD to euro. Okay, another concept is the price currency. We need to be aware of the quote convention. There is a direct convention, there is indirect convention, but I think the most popular one is to take the upper currency as the price currency and the lower one as the base currency. Okay, so the price currency is the USD, the base currency is the euro. If you think about this in naira to dollar, so you can think of this USD as now your naira and the euro as your dollar. So NGN to USD, right? So here we have USD to euro. Spot rate today is 1.18. Expected rates in 1 year is 1.16. Based on this, is the euros expected to appreciate or depreciate? So what's appreciation and depreciation? Appreciation means one currency is gaining value relative to another, is getting stronger, and depreciation means that the currency you are talking about is getting weaker relative to the other. Okay, do we have answers? Peter says appreciates, Reginald appreciates, Vivian depreciates. Okay, so we have different opinions, so we need to take that carefully. Remember, I said you should think about it in terms of NGN USD, and you can also drill with the decimal points. In some of these questions, decimals can get us easily confused, right? If it's an exam, so you can drill with, of course, if you drill with decimal in one part, you have to drill with the same number of decimal in the other part so that you are consistent in your calculations. So if you write out your USD over EUR and you put NGN USD for simplicity, NGN over USD in brackets in front, and then you write today it is 1.18, or let's just call it 118. In 1 year time, you're expecting it to be 116. If you think about it in Naira USD, if everybody is with me and you've written that out, as I'm also writing it out, just to walk through the process with us together. So you are saying for me to get a dollar today, right? Not to get you confused, when I say dollar now, I've written it in terms of NGN USD. So you might want to write that as well in your notes so that we are moving at the same pace. So I've rewritten USD EUR as NGN USD just for simplicity, So if I get I can get one USD today for 118 naira. In 1 year time, I can get it for 116 naira. Now we are looking at the perspective of EUR versus USD. So in this case, if you've written NGN USD, you are looking at it from perspective of USD versus NGN. So has USD appreciated or depreciated now? Okay, because you have USD twice. I hope I've not gotten you confused. Because you have USD, twice now. So let's go back to USD EUR. So USD EUR is 118 today. I've removed the decimal, and in 1 year time is going to be 116. And I'm asking myself, what is happening to the EUR in 1 year time? Is it expected to appreciate or depreciate? What do you think? It means I need a lesser amount of USD per EUR. That's what it means. I need a lower amount of USD to get EUR. So what is happening here is that the EUR is depreciating. What is happening is the euros is depreciating. That is the correct answer. I hope that is clear. We have 8 minutes more. I was hoping that we'll have time for questions and answers, but unfortunately, not. Okay, so what is happening is the EUR is depreciating. It is depreciating. I hope that is clear enough. Somebody said, okay, not confused. Okay, great. I hope that is clear to everyone. And then the next one is by what percentage? Okay, by what percentage? All you need to do is to take your expected spots and divide it by your current spots and subtract 1. So you're having 1.16 divided by 1.18 and you subtract 1. That will give you the percentage. Okay. What are we getting? Oh yeah, somebody, I just saw a impact lag. Yes, thank you. I was trying to remember one of the lags the other time. Impact lag, thank you. These charts, they keep jumping up and down. I'm not sure why, but yeah. Somebody said not clear. Okay, let me explain that again. If that's the only thing we do in the next few minutes, I think that will be very useful. Okay. If you take, please just write what I'm saying on your notes so that we move together. So write USD. This just the way we've been given the currency pair in this question. So USD over EUR. Just write that in your notes. USD over EUR. Say equals 1.18. Just write that. USD over EUR equals 1.18. Just beside that, put comma 1.16. That's for the second one. Now next to that, write NGN USD. Write NGN USD. Say equals 1,180. So we are removing the decimal now. 1,180. Put comma 1,160. Or so that the difference will be more glaring, put 1,000. So NGN USD, first write 1,180, then next to it you put 1,000. What's happening is the rate is reducing, right? So it doesn't matter. What we want to try and achieve is to understand the concept of appreciation and depreciation. So the rate is reducing. When you're calculating the percentage, that's when the actual numbers matter. But just for simplicity, so that we can get the concept. So after you write 1,180, put comma 1,000. We said for it to be clearer to you, just use the currency pair you are familiar with. So today you are buying a dollar for 1,180. You are buying a dollar, remember, for 1,180. In the nearest future, what you are now saying is, I'm going to be buying it for just 1,000. Are you better off, or is your currency, in this case naira, is it better off or worse off? Right? Is your currency better off or worse off? Please, I would need answer from at least one person, or the person that said it's not clear, so that I'm just sure that you said it's better off, right? Your currency is better off. Now, on the flip side, what has happened to the USD? USD is now, I'm still on that NGN USD from 1,180 to 1,000, right? If your own better currency is better off, Naira is better off now, right? It means Naira is appreciating. It then means that USD is depreciating. That's just what it means. I mean, as one is appreciating, the other is depreciating. So Naira is appreciating, USD is depreciating. Now go back to the first one you wrote, which is the question, USD EUR. So 1.18 versus 1.16. If there's that movement, what is happening to USD? I mean, USD now is your Naira in the other pair, if that makes sense. So what is happening to USD? So USD is getting stronger. It then means Euro, which is the the base one now, which is what the question is asking us. Euro is depreciating. I hope that's clear. So I think that pro tip is just think of Naira to dollar, whatever currency pair you are giving, just think of Naira to dollar, and pick numbers that will help you better understand what they're asking you. So instead of just picking, they've just given us 1.18, 1.16, you can pick larger numbers. As far as they are not asking you for the exact calculation, if the question is not to say what is the percentage, they're just asking you for depreciation or appreciation, just pick numbers that reflect. So if it's increasing, put numbers that is increasing, but you can put a larger number and think of it as Naira to dollar to better understand the concept. I think that would be clear. We have more questions here, but we don't have so much time. But I think in 3 minutes, let's just solve this question too, just to get the spot rate. And then we'll end on that. Okay, so the spot rates. So we have USD GBP, and then we have USD EUR. Our target is EUR GBP. Sorry for the typo again. EUR GBP. That's our target. EUR GBP. That's our target, right? So we are giving USD GBP. We are giving USD EUR. We want to find EUR GBP. Of course, you can see that what we are giving USD is common to both sides, right? USD is common to both sides. But which one do we want to be on top now between EUR and GBP? Yes, we want EUR to be on top. It means we have to transform the other side such that EUR is on top. So it means what you are going to do is USD GBP divided by USD EUR. Remember, when you are dividing fractions, right? The one on the right side, you then flip it over to multiply. So you then have USD GBP times EUR USD. That will give us, so USD will cancel USD out. I hope people are writing as I'm writing and talking so that we are moving together. Okay, then you'll be left with EUR GBP. But remember that we've already flipped this second side upside down. So what you would then have when you are doing your calculation is 1.120, what's this? 1.2604. You are doing it divided by, you are dividing it by 1.1786. That's what we did essentially, right? USD GBP divided by USD EUR. So 1.2604 divided by 1.1786. That will give you your answer. And I think that should be B. Yes, correct. B. Thank you. Somebody said I should repeat, but we don't have much time. I'll just quickly go. So we have USD. It will do us a lot of good to also be writing if you are not writing or unless it's not clear. So you have USD GBP, USD GBP, and then we have USD EUR. Remember, what we are trying to work towards based on the question is to find the cross rate for EUR GBP. That's what we are looking for, EUR GBP. So once you have your targets, before you, then you look for how do you transform what you currently have to give you what you are looking for. So you have USD GBP, you have USD EUR, you are looking for EUR GBP. Now, in the first currency pair, USD GBP, GBP is already the denominator, right? And it's also the denominator in what you are looking for. Okay, so all you need to do is to find a way to bring EUR up. Okay, so from the second currency pair, USD EUR, you need to bring EUR up. What you can do to do that is to say the first currency pair, USD GBP, divide it by USD EUR. So USD GBP divided by USD EUR. And I said when you have fractions and you are dividing fractions, what you'll be left with is USD. In fact, well, it's just for us to see to be able to eyeball what we are doing. So this gives us USD GBP times, we then flip the other side around. So EUR USD. So if you write that, USD GBP times EUR USD. So USD cancels USD, top, bottom cancels each other out. You are left with EUR GBP. So what you need to do to get EUR GBP is to divide the first currency pair, USD GBP, divided by USD EUR. So you are doing 1.2604 divided by 1.1786. That gives you your currency pair, the cross rate you are looking for, EUR GBP, and that should be option B. Okay, so that I don't eat too much into the next class. Thank you very much, everyone. The slides will be shared, and bye for now.
Thank you very much, Damilare. We really appreciate it. Thank you so much. Our next and last class for today is corporate issuers, and it's going to be taken by Abiola Ahmed, who is already in the room with us. Thank you very much, guys.
Okay, good afternoon, everyone, and welcome to today's corporate issuers class. So I'll share my screen. All right, please confirm you can see my screen.
We can see your screen.
All right, thank you. So what I've done is there are a couple of topics under corporate issues, quite straightforward. What I want us to do, I have an hour, is to zoom in on four of the topics, and these were picked based on how tricky they could be and some of the pro tips I would like to share. So let's quickly go through this. So we'll walk through working capital and liquidity, capital investment, capital structure, and then closer with business models. So basically, what would you under working capital and liquidity really is to say how or understand how businesses finances their day-to-day running activity, right? So typically you are looking at the current asset, current liability, and the like. So you look through some of the requirement and likely questions in there. First, I want you to look about the cash conversion cycle. Really, for cash conversion cycle, what you are looking at is from money out to money in. Just want to measure how long does it take from the time which by a company probably make the investment to the point whereby the investment is turned into product that they can sell, then to the point whereby when they make the investment, then they part with money, right? Then they make the investment, probably it's an inventory, it's a raw material they are trying to put in a factory. And then they do the production process to the point where they have the finished goods. Now, that's where the item is converted from inventory to actual product to be sold, right? Then they make the sale. If it is cash at point of delivery of their product, very good. If they align some payment terms, that's another. Then the product, they part with the product, then wait for a couple of days for them to receive the cash or payment. So that is actual receivables that they recognize for the next 30 or 60 days. And then you look at what other things shorten the time with the part with money. So items such as payables. So typically you could look at this like a straight line. I don't know if you can see my screen. So we have money out when you part with money as a business owner. The inventory days goes this way, and then you have another couple of days whereby you have sold the product and then you're waiting to receive cash. However, you could also explore things like supplier finance, whereby you wouldn't part with your money at day T plus zero, right? So that's shorting the cash conversion cycle. So you have things here, either days of inventory on hand, where your production process is taking place. States are standing where the item is now receivables, and then you could actually net out the days of payment. And you can understand why the society, why the institute would like to ask questions like this, because it's leverages on 2 or 3 level of thinking, right? From your FRA, because you need to understand so things like days of inventory on hand, inventory turnover, days of sales outstanding, receivables turnover, days of payables outstanding, and payables turnover. So this kind of questions entices them because it shows that you understand 2 or 3 layers of topics before you can actually solve this kind of questions, right? Another thing I would like us to know again is effective annual rate. So typically, because part of the question they will probably or they usually like asking is around inferences from this formulas. So if I have a cash conversion cycle, how can I as a business for businesses, the ultimate goal is to shorten this cash conversion cycle, the time between money I'm parting with money to the time in which I'm receiving money. You can see businesses to the point whereby they can actually have so much supplier financing that the piece of paper outstanding can make them have negative cash conversion cycle. That means essentially when you have negative cash conversion cycle, that means you're actually running your business from things like supplier financing. So you could see businesses that are like hubs, let's say supermarket, whereby you just have the presence, the location, and you have all the goods in there are all supplied there on credit, and you tell those suppliers that I will pay you 30 days, but you are making sales from day one, right? So you actually funded the business even from something like supplier financing, right? So and again, it's one beautiful thing about finance is it's all transparent. So suppliers also want you to pay them almost instantly. So they issue something like, if you pay me within 10 days, you have like, let's say, 10% discount, right? And then the question now comes to you as a CFO or a finance manager and say, should I either get 2% discount if you pay within 10 days, or pay my full payment in 30 days? What is actually the implicit cost of financing, right? So that's what things like this effective annual rate measures. The implicit cost of finance, whereby when you delay payment to suppliers such as this, because you have, as a business, you have alternative of either financing, getting a loan to pay instantly so that you can enjoy the 2% discount. So the question around, how should you take the discount, or wait for and pay the full payment in 30 days, right? So these formulas, I have scoped that formula in here, very important. So you measure something like, okay, it is 1 plus, if it is, let's say, imagine that they are giving you 5% discount. So 0.05 divided by 1 minus 0.05, that will give you like 0.95, right? Then raised to power 365, they count in the year, divided by, so typically if it is pay me within 10 days and get 5% discount, or pay me in full in 30 days. That means the gap for the financing is 30 days when you pay in full, minus 10 days when you have the discount. So that will give you 20. So with this, you can quickly compute what is the implicit financing, or what is the alternative you are foregoing, right? When you take off, when you
Please,
don't
can you
pay.
put your slide?
Okay.
Thank you.
Please, just a minute. Let me see. Can you see my screen?
This is far better. Thank you.
All right. So for us to compute such, and then we can make that comparison. Should I wait and pay in 30 days, or should I take on the discount the issuer is, or the supplier is offering? Another thing I want us to look at also is total working capital and net working capital, right? Total working capital actually encompasses. So when you look at your income, your balance sheets, right? So you have the cash, financial asset, and the likes. Current asset encompasses all of these liquid assets, right? And then, so if you're looking at working capital, you are saying current asset and current liability. However, if your business is typically, let's say, typical manufacturing firm, your principal business is not holding cash or having financial instrument on your balance sheet as asset, you are actually into production. So for me to assess how well you are managing liquidity as such as a business that is into, let's say, an FMCG, I should not, or generally not measure you based on how much cash you are holding. That is increasing your current assets. So I take out those cash, I take out those financial instruments you have on the current asset, and then look at what is actual working capital. So when you have questions around net working capital, basically what you are doing is to exclude cash and marketable securities on the asset side, and then on the liability side, you take out short-term and current debt. Yeah. Also, for businesses, another thing we want to look at is, what are the primary liquidity sources? Basically, what are the sources of liquidity that do not, in a sense, signal or have red flags attached to them, or what are the, so that are easily accessible to the company? So you have your cash that you have on your balance sheet, your bonds, financial instrument that you hold, typically your relationship with your financiers, the banks. So typically you have your line of credit, you have your revolving credit with banks, your overdraft, right? Then you have the actual cash you generate for the business. Then for secondary liquidity sources, talking about actions to stem the rate of, or the rate of cash burn for the business. So you have things like suspended dividend payment. So you have your profit, dividend payment is actual cash you are parting with the equity holders, right? So when you suspend such payment, then you can actually retain more cash in the business, right? Also, sometimes you reduce capital investment, and you could quickly see why these secondary liquidity sources are painted like some form of red flags, because when you can reduce or delay capital investment for so long, because what you do when you delay capital investment is shorten or slow down the rate of growth of the business, right? So that is why we're looking at the second liquidity sources as something that these are the source of funding or retaining cash in the business that have attached to it, that have red flags attached to it, right? Selling assets, you have a floor to amount the number of assets you can sell, and again, it has a consequence of reducing your rate of growth and also market share and other verticals attached to it. Issuing additional equity, restructuring debts, and also bank custody protection, just so that you have some protection from debt holders whereby you restructure and then get back on your feet as a business. They are all secondary liquidity sources. So it's very good for us to have that understand the dichotomy between these two. So you can, in the back of your mind, you can have something around which, if you have list of options, which of these does not have attached to it some kind of red flags. So if I'm asked to identify primary liquidity sources, so I want to look at it in that way, red flags and does not have negative signals attached to them. Another thing I've seen a couple of times also, difference between drag on liquidity and pull on liquidity, right? So for drags on liquidity, these are activities that slow down the cash inflow, the amount cash inflows into the business, how fast cash comes into your hand as a business, that cash comes to the books. On the pull side, this occurs when the rate at which you part with cash, or the frequency and the time with which you part with cash becomes accelerated, right? So typically you have payables or supplier credit that says payment 90 days. If that get cut into two and say supplier then say payment 45 days, and you can quickly see how that stretch your cash out or increase how fast you let you part with cash as a business. So those are pull on your liquidity. So the drags actually is when things around your inventory builds up, you don't sell as fast as possible, right? Or if your receivables gets delayed, how fast your payment comes from buyers. So these are drags on liquidity. Again, you see your corporate issuers built up on FRA, right? So in even in terms of how advice could read, you have your strong hold on FRA before coming to corporate issuers. So liquidity ratios, these are what we treated at under financial statement analysis, right? So we need to have our hands a very good grasp of that. Current ratio, typically current ratio encompasses all of the line items under current assets over current liability, right? But then when you talk about quick ratio, you're taking out cash and market inventory. So again, then you have cash ratio, which looks at just cash. So it's a build up on FRA. So you need to have a good grasp on FRA, perform very well on corporate issuers. So just to put that out, let's take another. So another topic here: capital investment and capital allocation. Very, very important. And again, here I think what helps very well here is your understanding of quantitative methods, right? All of the time value of money will come handy here. Your time ability to draw timelines and ability to actually then structure or pinpoint cash flows and timing of those cash flows, right? So for capital investment, typically businesses have list of investment that they need to do. So I highlighted like 3-year going concern projects. So typically for you to be in business tomorrow, these are items you need to have, or these are investments you need to make. So think around for the maturity manufacturing firm, you need to have power, right? So those you have to make little analysis on such product also on such projects, right? Regulatory and compliance projects, these are you can't operate if you don't have those are investments that give you license to operate. So think around, okay, into a refinery, you need to have some environmental impact assessment, you need to have some licensing, ISO licensing and the likes. So investment to qualify or have those licenses and regulatory compliance projects, right? Say you need to have some kind of valve, something on your exhaust. So you can't compromise on that, else the whole license or the business come crashing when the regulators comes. Expansion project, yes. And this is where you make the bulk of your analysis, right? Because you don't want to destroy value. You are in business to create value for shareholders, right? So for expansion project is where you do the bulk of analysis that we are going to be describing under this chapter. So I have a factory. Should let's set up another factory adjacent to this? I'm into making soda and the likes. Should I have a complementary project or factory that's in water production, right? Should I do I have operation in Nigeria? Should I go to Ghana or start operating in North America? So these are expansion projects. For you to make those decisions and commit to those capital investments, you need to have a strong grasp of the number, how much value is going to be created, and what exactly is the return to investment and the like. So in terms of measuring this, we have couple number of metrics that we use. Top on the list is net present value, right? NPV. Net present value will compare your
Hi everyone. Sorry, apologies. We're looking into what happened. I think his network must have cut off.
All
Hi,
right.
Abiola, are you able to speak now? Okay, awesome.
Yes, fine. Apologies, I got kicked out of the meeting. Okay. All right. Like I was saying, for computation of for net present value, quite a number of metrics are very important. Cash flow, then timing of this cash flow, and you quickly see when we come to computing some of these numbers. So for a typical project, even if they have the same 15 naira cash flow in terms of, okay, so let's imagine the cash outflow of two projects, both 500. And I mentioned earlier that this is where your quantitative methods around time value of money will come in handy. So these two projects has the cash outflow of 15 naira. However, so let's call project B and then project A, project, so with 4 cash inflows. But for project B, there is no cash inflow till, let's say, the third year, when we have 150, and then the last year we have 50. Total cash in is 200. However, for project A, we have 50, 50, 50, and 50. So that's total of us 200 also. However, you see when we do computation on NPV, project A will outperform, because when you calculate the NPV favors project whereby you have cash inflow early into the early into the life of the project, right? So this drought time for project B will significantly impact the NPV value when we do the computation. So things like that. Also, project riskiness, and we have an entire expose on computing the rate of return, or what the rate of return would be, what the investors would demand for project. It differs, and what the investors will look at is the riskiness of the project, right? How familiar they are, how novel the project is, and so the rate of return that investors will probably ask for a fintech that is trying to do something novel will be much more higher than what an investor is going to ask for a cement factory, in which it has tested and trusted technology to be done. It has a lot of experts in the industry that they can pull into the team. So rate of return reflects the riskiness of the project, and also at net present value also look at the timing, not just the cash, but actual time with those cash will come, right? Under metrics we use, and again, level 1 is where you have to have a good grasp of the formula. There is fact sheets, there is quick summary sheets. You need to have all of this formula at the back of your hands, and then your calculator. I hope we all have a good grasp on that calculator, right? Under metrics, because all of this you could do that with your cash. There's a time value of money on the third row of your calculator, right? And sorry, on the second row, the NPV formula is right there. The IRR formula is there. So instead of writing these things out, once you have a good timeline, you can put in those values in your calculator to get your answer very fast. Another metric that's being used is internal rate of return, right? Internal rate of return really has some assumption inherent in it, that the cash flows are reinvestment at the initial rate of return. Really, what internal rate of return is measuring really is the order rate. So you are trying to see what rate of return will set the series of cash flows from this investment to an NPV of 0. So you are solving for this rate of return. You can imagine that under the NPV, you already have the rate of return and you're just solving for the present value, right? But here, you are solving for this internal rate of return, for that rate of return itself. And the number, whatever number you get in there, let's say you get 12. On the standalone, you cannot say, no, on the standalone, you can, once you have a positive NPV project, that's a good signal. Well, you can then now say how positive compared to what. But on the IRR side, you get a number of 12%. On its own, it's communicating nothing until you say compared to what. Let's say I have an open rate as an investor of 20. So I will not get excited on a number of 12. So the 12, so really what IRR gives a signal of is like an order rate. It's like an order rate whereby you then say IRR of 12. So investors can say IRR of 12, I need something that is more exciting, 20. I need something that's, or if I'm comfortable at 5, if something is promising me 12%, I'm fine with it. So that's what IRR said. So IRR is setting the NPV to 0, and we are solving for this rate of return, that discount rate we use on NPV side. Let's move on quickly. Okay. So other metrics, let me try and clear this. Other metrics we have here is return on invested capital. Again, like I had said earlier, you need to have these formulas at the back of your hand. Here you're looking at net operating profit after tax divided by the average value of invested capital. So again, this is comparing what is the return to both debt and equity holders, right? And that is where we are looking at the average book value of invested capital. And again, our mind must be on that also. When you look at average, you're looking at beginning and ending book value of this invested capital. So you need to do the beginning, debt and equity, ending debt and equity, and do an average of that. So it's also very important for us to take note of that. So we could use this formula, net operating profit after tax, but then also we have this expanded formula, right? No part of invested capital, no part of ourselves. So you can just cast your mind back to when we do analysis under FSA. You do your return equity as return asset times financial leverage. However, you have the 3-way and the 5-way analysis. Again, those are the fringes or the marginal places where exam questions usually come to. So you don't want to be caught unaware. If you don't have no parts, or you don't have, so you could actually expand this formula to this point, so you can have some more granular level of questions that could come in during the exam. All right. Again, let's move on. So here we are looking at capital structure, right? Under capital structure, we are looking saying that if you have your business, remember your standard balance sheet formula: assets equal to liability plus equity. So you finance the asset as a business using debt or equity. Now, the question to the CFO, the question to the MD is, or the CEO is, how much of debt should I have, or how much of equity should I have this business? And that is the question you are trying to answer under this capital structure. And you know, this has its own implicit or attached associated cost. So if you are using equity, then you have a lot more transparency. You know, you have agency cost and the likes. And if you are using debt, then you have things around your tax shield. Then the potential for debt, you have the promised contractual payment in terms of interest and principal, right? For equity, there's no contractual payment. You can have conversation with your shareholders and say, this year I'm not paying dividend, right? And there's really no much of litigation that could arise from that, right? But for debt, you cannot just have that. It's not easy conversation. Yes, you can have conversation around the structuring and the likes, or go do the bankruptcy shield like we talked about earlier. but those conversations are very tough conversation, right? And those are the thinking you must have as a CFO, as a CEO around how much of debt, how much of leverage, how piling a business, and you look at the essential cost. So first formula that I want us to also have eyes on is weighted average cost of capital. Weighted average cost of capital, and we see weight of debt times cost of debt. But remember, for debts, you have tax shield whereby you pay the finance cost before you are then taxed the remaining. So you have cost of debt multiplied by 1 minus tax rate to account for the tax shield, right? Then you add on that the weight of equity multiplied by the cost of equity. For this weight of debt, remember, also use the market value of the company. So debt over market value of debt of the entire company, then equity over market value. So you can get the proportional weight of these two financing options. Also, I've highlighted this here because it's also very important in terms of theory. These are much of what are the theories that support capital structure. We have the MM1, MM2, MM with taxes, and the likes. So it will be very, very helpful. We have a grasp of these theories because it comes into your how the context or how you solve your question. So let's go through this in bits. So they are being paraphrased there, but we can take our time on. So the proposition one, where it's an ideal word, right? Whereby there are no taxes. None of that exists in reality, right? And you can quickly see how this can be very, very complex or can be very unrealistic. Capital markets are perfectly competitive. There are no transaction cost. Doesn't exist. Investors have homogeneous expectation. No. We have asymmetry. We have investors that just investing based on even emotional attachment. We have an entire section on behavioral finance, right? So investors, if you have 10 investors in a room, you most likely have 10, maybe 10 plus 1 intentions also. And also they have the same expectation with respect to cash. No, all of this actually diverges between investors. So we have proportion 2, again, cost of equity increasing nearly as company increases proportion of debt finance. And we quickly understand that because in the hierarchy of claims, we have the senior secured debt, the debt holders in terms of when we are having liquidation of assets, in terms of when a business fails, debt holders, because they are contractual, they are the finances on contractual basis, they have higher claims on the asset business, right? And then, so you as an equity holder, if a business that is highly levered, then you can quickly see the risk associated with it, that if anything should go south, the debt holders have higher claim than I do, so that for the level of risk I am going to undertake by investing in this business that is very levered, I should have a competing or compensating return. The higher the risk, the higher the return, right? So that's what the two position is saying, that as the business pile up debt, the cost of equity also increases because shareholders ask for much more return to compensate for the risks they are taking. And then we have the MA taxes. So all of this, I'm also highlighted the formula to support this so that you can quickly glance through and take this theory to support those questions that we might likely have. Again, we have the static trade-off theory here also, which says the amount of debt financing in which this financing increases in the value of the tax shield from additional borrowing exceed by the value of reduction in by higher expected cost. So what we are looking at is the value of a levered company, right? As you because if you have unlevered company whereby you are all on equity or you are financing business with equity, the moment you decide to take on debt, you expect, let's say the business is valued at let's say 30 million. When you take on debt of 10 million, you expect the value of the business to go up. However, the increase in value of the business does not go out proportionally with at 10 million, right? It goes up by the level of tax shield. So you have 1 minus tax times this multiplied by the debt you are acquiring. Then on the statistical theory is saying that we have a optimal capital structure, in which point that when the level of debt you take on, because you are just confirmed there, that established there, that the value of a levered company should be higher than the value of an unlevered company by the level of tax multiplied by the debt that they have taken. However, as you take on more debt, because that would then say it should, well, to increase the value of the company, just keep piling on debt. However, there is a limiting factor. The limiting factor here is the present value of the cost of financial distress that then drags down the value of the business or the overall value of the firm, right? And it is at the point whereby you then have diminishing marginal return by our economics on diminishing marginal return that you should stop in terms of how much debt you acquire as a business. So that is what this study trade-off theory is speaking to. So it's something we should be aware of, and we have questions around it. Again, we have this pecking order theory, which says that business managers really want to disclose, want to have minimum disclosures, right? So in terms of financing, what are the financing options that gives less signal to the market, right? And probably also attached to it is lower level of disclosure. So you want to finance a capital project as a business manager. The easiest way where you don't need to talk to anyone, or you don't need to talk to a lot number of people apart from your board and probably some level of shareholders engagement, is just retain earnings. So remember your traditional growth from the business cash flow, right? You just say my profit this year, I then plow it back into the company and go next year by maybe another 10% or 15%. After that, you then say you want debt. So for loans, you probably want to disclose probably your other financial statement, and probably you have your bank relationship, less disclosure, right? But the minute you say you want to have equity, so you could see from retained earnings to debt, and then you have on the equity conversation. Thankfully, in Nigeria, we have a couple of banks in the market to raise capital. You can imagine the level of disclosure you need to do from the regulator to even the market itself, right? And also how tasking that conversation can be. You have investor presentations, you have prospectus, quite a number of things. So level of disclosure attached to such financing is also high. So for pecking order theory says that in terms of financing a capital project, for a manager, where do they start from? So they first take on the cheapest, or the one that has lowest level of disclosure attached to it, which is the retained earnings. After that, they take on debt, and then the final resolve to equity. So typically that's what the pecking order theory is speaking to. Let's move faster. So the last item here really is business model. For on the business model side, it's just saying that if you have a business in front of you, typically how is it being financed? One, how do they want to finance the business? How much money would they need? How would they generate profits? And how much profit would they generate? Really, that's what the entire spectrum of business model is speaking to. But also, I've also highlighted a couple of pricing strategies here that I think probably the questions can come from, in terms of how you price your products, and how you in the ultimately generate revenue as a business. So you have the bundling. Bundling really is to say if you buy this, you have to buy that, and couple those two items together and prices at one, right? Bundling. For razor and blades, what you are doing really is say let's say you have a low entry point. Think around your DSTV. So you have the decoder, right? But on the back of that decoder, maybe after the first 3 months, you then have add on the subscription fees. Or let's say your printer, you buy the printer, but then you then have to buy cartridges and the likes, or probably you buy a card and you have to buy fuels and the else. So really, that's razor and blades. You have a first product, and then you need to buy more products. So think around your HP. HP will do printer for you, and also then do cartridges and sell inks and the likes. So those are razor and blades. So you have a first product which then generates, which has a network of products attached to it for it to function well, and then generate even more revenue for the business. So we have the add-on pricing. So You have a first entry point. On the back of that, also you have that. Even though you the product itself, for the reason I'm the product probably will not function so well without you buying the cartridges and the inks. But for the add-on pricing, it will function. So think around your car. So your car, but then if you want to, let's say, tune up, then get this kind of leather seat, this kind of this, and tune up and all of that. So add-on pricing. So you have penetration pricing. You basically, yeah, you are talking about competition. You want to come into market that is already saturated. How do you break into the market? Also, we have premium. You could see this on number of apps, right? You have the basic, then you could have standard, and then when you subscribe or make some payment, you can have added features attached to it. Hidden revenue. So think around social media is free to use, but then your time and your eyeball really is how to generate revenue in that space. So the revenue is not explicitly disclosed to the user, but then adverts gives the product owners revenue, whereby you as a user just consume it without explicitly paying. Subscription model also exists, licensing and franchising, think around. I think NMP also is into that now. So the name is being sold like a franchise, and then you can have your filling station established, and then get that franchise and put their label on it on that filling station. I think McDonald's and the likes also do that. So basically that's what I have in terms of notes and some highlights I want to look at. Maybe we still have some time and we can check in on some questions. But for what we are presented, or for what I have presented, is there any question while we move on to the curriculum? Any question? Let me check the chat. Okay, so if you have question, you could drop it in the chat. Or if anyone has particular question they want us to treat, we'll bring it up and we can address it as a class. Where let me go to the curriculum and see if I have some questions in there. So let me share my screen. Okay, I think this is on working capital. This is the first topic we treated. So let's look at this question together. An issuer changing his credit terms for customers from 210. 210 means have a discount of 2% if you pay within 10 days, or pay the full on the net on 30. So 210 net 40, we most likely experience a pull on liquidity, drag on liquidity, no change in liquidity. What you are doing is you are expanding the receivables days. What do we say? Please confirm if you can see my screen. Okay, so we have.
Yes, we can see your screen.
All right, thank you. BA drag on liquidity. Remember what we had discussed earlier, that drag on liquidity is whatever slows your cash inflow. Pull on liquidities accelerate your cash outflow. So that context, let's use that context to answer this question. Yes, I'm saying drag. Dragged, yeah. So we have that sorted. The answer is drag on liquidity. Thank you. So let's move on. Which of the following most likely decrease an issuer's cash conversion cycle? And I had said earlier that question around interpreting the formula that we showed earlier is also very important. Which of the following most likely would decrease an issuer's cash conversion cycle? Sales outstanding, inventory on hand, payables outstanding. Yeah, payables outstanding. Remember that our formula, right? Payables outstanding is a negative. Net it out of the cash conversion cycle. That will most likely decrease, shorten your cash conversion cycle. And we have said there, we won't have the extreme portion whereby you can actually finance your businesses strictly from just suppliers finance. That's payables outstanding overwhelms your inventory on hand and receivables outstanding. Okay, most liquid. Which of this is most liquid based on quick ratio? Remember our formula: current ratio, quick ratio, and then cash ratio. So which of these guys will be most liquid? For quick ratio, so which of them? I'm saying C. All right. Imagine we have very, very sharp people in the team. So okay, this final question. Let's do 5. An issuer has limited the prompt payment discount it had offered customers. Look at it. An issuer limited the prompt payment discount. So it usually offered to customers. This most likely will increase issuers liquidity, decrease issuer liquidity, not affect. Yeah, Peter B. Let me B. Yeah, exactly. Decrease the issuer liquidity. So because if I don't have a discount to run for, if I pay early, I will as well just wait till the nets I'm paid on the 30 or 60, as the case may be. So at that point, you could see that is a drag on your liquidity. It slows down the rate or the pace at which your cash inflow comes. Okay, let's go to another topic. Let me move back to one. So please, these questions it can look like a mirror. So we need to have a good grasp on what each of them means. Like drag, what does drag means? Pull, what does it mean? Theory is also very important for us to understand theory, so that when the question comes, we can actually address them effectively. So this is more of a case study. So when preparing cash flow forecast for project, yes, it's very important for us here. So what do we do when preparing cash flow forecast for a business? We should include cost of market research, only the loss of revenue from existing products, or both. What do we say? Remember, explicit cost, implicit, explicit and implicit revenue or cost. Only the loss of revenue from existing products. Yeah, that's cannibalism, right? Exactly. Market research is just expensed. So really, don't look at that. Yes. Just look at the loss of revenue from existing products. With regard to project A and project B, which of the following is true? Both projects should invest according to, so let's quickly do the computation. Project A and B. So this project A and this project B, cash outflow of this. What is the NPV based on this? So let's all use this. NPV for A, and then compute the IRR for A and B also. Let's use our calculator. What's the answer? Just type in what you get as your NPV for project A. So we have 18.5 as cash outflow. Cash flow 1 is 4.5. Frequency 1. Cash flow 2. Like I said, your level 1 is basically your calculator must be your friend. Then cash flow 4, 5, 5. So compute NPV. Discount rates, what's the required rate of return is 8%. What is the NPV that we got for project A? We need to have speed. Project A, what is the NPV? Can somebody help? Yes, favor. Thank you. Negative 0.38. Any other different answer? Let's do for, I got negative 0.38 also. Okay, so we confirmed negative 0.38. For budget B, what is the NPV, please? Remember to clear work after computing your NPV, please. It's also very important. 3.5 negative alpha 1. Sign is very important here. For budget B, what's the NPV? Yes, Abolaji 1.12. Any other different answer? Okay, we have 5 minutes more. So, I got 1.12 also. Any different answer in the team? Okay, so we got 1.12. Let's compute the IRR for the two projects. $1.96. What's the IRR for project A? $7.09. Thank you, Lamidi. So Feature got 7.09. Any contrary answer? 8.5. Yo, same. Peter got the same. For project B, what is the IRR? I got 7.09 also for project A. Project B, 8.97. Yes. Feature, thanks. That's what I got. Now, Major, what we should do now, let's interpret. Question 2. With regard to project A and B, Wale, thank you. Chig, okay, I think we all agree on the answer, the NPV and IRR. With regard to project A and B, which the following is true. Both projects should be invested in according to the IRR decision. Remember, we are talking about what we said something around the what is the benchmark? The investors have a required rate of return of 8. Let's have that at the back of our mind. Okay. Both projects should be invested in according to the NPV rule. Only project B should be invested in according to the IRR rule. Who can help us? What should be the answer for question 2? C, Fetia. C, exactly. You can see on the NPV side, project A failed. On the IRR side, project A failed because you have an order rate of 8. Only project B crossed the order rate of 8. So it's very important for us to not just not compute, but interpretation is also very important. So we see questions like this that basically is just testing how to understand, how to interpret. Question 3, most likely from cash flow timing considered by Saroka is what? What's the cash flow timing? Let's see. As to consider in a forecast the impact of a 6-month delay in all future cash flows. So what's the impact of this? I talked about that cash flow timing is also very important for him. So question 3, what would be the answer? Cash flow timing, question 3, both IRR and NPV will decrease. Yes, Francis said both IRR and NPV will decrease. Exactly. So we have again. So we see for your cash flow, the time of the cash flow impacts these project profitability metrics. Decision rule, once the cash flow is extended, the NPV comes down, RR also comes down. So let's have that also. Based on balance sheet, so should calculate average invested capital of 72. Again, let's look at this. It's consider our return on invested capital. What will be the look at the maybe it's minus as an estimate for 20x2, if you say an operating profit. We have operating profit already given. Remember our formula, effective tax rate of 22, and then balance sheet. So here we want to, what is the first let's compute what is the average invested capital. Remember, we have to look at both debt and equity. Both debt and equity, that's what we're looking at. So question 4, what's the answer? Average invested capital and ROIC. And like I said earlier, your level 1, your formula must be, you need to have a game on the formula side, and also your calculator must have, you need a game on the calculator side also. So when we have those two in within our control, it's usually a cost to success. Tim Tokwe got A. Thank you, Tim Tokwe. Any other contrary answer? We are all aligned on this A. Okay, we have A from Fetia also. I don't know this other question. All right, I think our time is out. I wish everyone outstanding success as you write your exam. Remember, calculator and your formula needs to be a game. Thank you so much. Thank you to society for having me. Thank you.
Thank you very much, Abiola Ahmed, CFA. Thank you for the class, and thank you everyone that participated in today's class. Tomorrow, the class continues for level 1 at exactly 12 noon. And that will take us through 3 different classes also. We'll be having ethics and professional standards. We'll be having derivatives. And I believe I mentioned the last course that we'll be having for tomorrow. Please let me confirm it with you. And that course is going to be, please hold on. That is going to be quant. We'll be having quantitative method also tomorrow for the second day of the level 1 revision bootcamp. We look forward to seeing you tomorrow, and we wish you all the best in your exams. Have a nice day.
We are professionals. We are impact driven. We are CFA Society Nigeria, a member society of the CFA Institute Global Network of Societies. Our mission is to promote the highest standard of